This is Al Brooks, and this is my price action trading course. The current module is about setups and signal bars. There's a big emphasis on the internet and in books on setups, and I think it's easy to come away concluding that a setup is a signal bar or a 2 or 3 bar candlestick pattern, and that if you simply get really good at spotting candlestick patterns, you'll make money. The reality is, I think most of the major hedge funds, most of the institutions, the high frequency trading firms make a lot of money, and they don't pay any attention to candlestick patterns. They're much more interested in context, where we are in the market cycle. Is the market in a strong bull trend? If it's in the breakout phase of a bull trend, they're buying for any reason. They don't care what the candles look like. And if it's in a strong bull trend, if there's a strong bear reversal bar, there's no way that they're going to sell. They don't care what the candles look like. If the market breaks out and then comes back to support, they're going to look to buy. If it is a bear breakout and it comes back up to the breakout point, they're going to look to sell. And again, they don't care what the candle bar looks like. I think everyone in their heart knows that Goldman Sachs, high-frequency trading firms, and all the best hedge funds out there are not really paying any attention to candlestick patterns. Yet, when you look at websites on educational videos, they're all about candlestick patterns. And so you know that something is not right, that you're being taught something that just can't be true. It's not what the institutions are doing. And that is absolutely, your instinct is absolutely correct. Institutions are much more interested in context, where we are in the market cycle, and in reading the strength of trends, looking at selling pressure, looking at buying pressure. The candlestick pattern, 1, 2, or 3 bar pattern, it can be helpful, but you don't need it at all to trade. However, it can be helpful, and because of that, I do talk about specific patterns. If you want to know what the bars to the right of the chart look like, look to the left. The market tends to continue to do what it's been doing. If to the left the market is in a strong trend, chances are it'll continue in a strong trend, and you should only look to trade in the direction of the trend. If it's in a trading range, you should only look to trade in the direction of the trading range. For example, if the market is in a very strong bull trend, it does not matter that you see a great-looking, strong bear reversal bar. You should not short. If anything, you should only buy. And any reversal pattern that you see, you should look at it and say, here's an opportunity to make money. But the opportunity is not shorting in a bull trend. What you do is, you don't take the short, you wait for a bar or 2 or 3, figure out where the bears would put their stops to get out with a loss, and then enter long exactly where they're getting out. So you should look at every reversal pattern in a strong bull trend as a bull flag, not as a reversal. Reversals do occur, but there's much more to a reversal pattern than simply a candlestick pattern, and I talk about that in the section on reversals. Here's an example of a strong bear trend. So the context is a strong bear trend. That trumps anything else that you might see. So you should not look to buy no matter how strong a candlestick pattern looks like. So here's a good looking candlestick pattern, a 2-bar reversal, but look what happened. It resulted in a low 2 short. The market tried to go down here, paused, tried to go down a second time. The bulls who bought here, they might have allowed the market to go against them once, but they're not going to allow the market to go against them twice. They're going to exit here. So instead of buying this, you should simply wait. And if you're lucky enough to see this, then you go short. And look at this, okay? Here are 2 decent bull bars, and however, it's far better to short below the low of the bull bar than it is to be thinking about buying a pullback. Here are 2 small doji bars, yet look what happened. We got a breakout. So it's far better to short below their low. It's far better to short this close. I talk about in a later module how to trade strong trends. But the bottom line is, if a trend is strong, and in this example, if it's a strong bear trend, you sell for any reason. You sell at the market, you sell above bars, you sell below bars, you sell the closes. It doesn't matter. You can just sell for any reason until you get short. And you should not buy for any reason, no matter how strong a candlestick pattern is. So the context is far more important than the actual signal. And here's an example of an opposite situation, a very strong bull trend. And we have a great looking bear reversal bar. And you can say, wow, it's a bear reversal bar. It looks perfect at the top of a trend, bull trend. That's when you should be looking to short. It is, except that the context is bad. This is a very tight bull channel and a very strong bull trend. And it's a spike on a higher time frame chart. You should not be looking to short, no matter how good the reversal bar is. Instead, what you should do is wait until it turns into a bull flag. The market tried to go above this bar, and the bears probably held short because that's not a very strong bull bar. But at this point, if the market tries to go up again, especially above a bull bar, all those bears are going to cover. They may get out break even, they may get out with a small loss, but they're going to cover. So to me, when I see this, it alerts me to the possibility that a bull flag will set up. I do not take that short. I wait for this, the second attempt for the bull to go up. Here's the first attempt, here's the second attempt, and I get long because I know these bears are going to buy back their shorts, probably take a small loss, and they're not going to be looking to sell again for many, many bars. So this is a great buy setup. And look at this. Here's a bear inside bar. But it's occurring in the context of a strong bull trend. And a strong bull trend you can buy for any reason. You can buy below a bar. You can buy below this bear bar for that matter. If you use the appropriate stop. You can buy above a bear bar. Here's a bear bar and it's a good buy signal. You can buy the close of any bar. You can buy at the market. You just have to get in and you can use any reason. And again, I have a module later on that talks about how to enter in a strong bull trend. The bar when you enter is the entry bar, and the bar that led you to take the entry is the signal bar. It might be the bar before, it might be 2 or 3 bars before. Here are some examples. Here's a signal bar, top of a channel, a strong bear reversal bar, and the next bar, the bar in which you actually enter, is the entry bar. Once you see this signal bar, if you're thinking about going short, you place a stop to go short at 1 tick below the low of the bar. You get filled on this bar, and that's your entry bar. Here, the market is channeling up in a weak bull trend, a bull channel, and there's a good-looking signal bar closing on its high tick. When you see that, you might want to buy this as a pullback from this breakout. You place a buy stop at 1 tick above its high, and you'd be filled on this bar. So this is your entry bar. To qualify as a bull signal bar, the bar should have one of 2 things. It should have at least a close above its midpoint or a close above its open, a bull body. So in other words, it can have a bear body as long as it closes above the middle of the bar. In other words, as long as there's a tail at the bottom that's at least half the size of the bar, that would satisfy the requirements of a reversal bar, a bull reversal bar. The very best ones, they open near the low of the bar, and they open near or below the close of the prior bar, and they close well above the prior bar's close. The lower tail is about 1/3 to 1/2 of the height of the entire bar, and the bar closes on or just about on its high so that there's no tail on the top of the bar. The best bull signal bars do not overlap prior bars very much, and the bar after the signal bar is not a doji inside bar. Instead, you'd like to see a strong bull trend bar for your entry bar. And you also prefer the close of the signal bar to reverse the closes and extremes of more than one bar. So in other words, you want the close of the signal bar to be above the close of the bar before it, and preferably 2 or 3 bars before it. So you want a very strong close on the signal bar. The minimum requirement for a bar to be a bear reversal bar is either a close below the midpoint of the bar or a close below the open. If it has a close below the open, it has a bear body. If it has a close below the midpoint of the bar, it can have a bull body as long as the tail on the top of the bar is equal to at least half of the total range of the bar. That would qualify as a bear reversal bar. The best bear signal bars, they open near or above the close of the prior bar, and they close well below the prior bar's close. There's an upper tail that is about a third to a half of the height of the bar, and the bar closes on or near its low. You don't want much of a tail on the bottom of the bar. You also don't want much overlap with the prior bars. The bar after the signal bar, you'd prefer it not to be a small doji inside bar. Instead, you want a strong bear trend bar for the entry bar. You also want the close to reverse the closes and the extremes of more than one bar. So in other words, you want the close of the bear bar to be below the close of more than one bar, ideally, or even below the lows of more than one bar. Sometimes you'll see a bear reversal bar that's very large, and it reaches down below the closes of the past 10 bars and the lows of the past 10 bars. And that's a sign of tremendous selling pressure. Another common setup is a 2-bar reversal. So instead of a single bar being the signal bar can be a 2-bar pattern. For example, if you're talking about a buy setup, you may see a bear bar and the next bar be a bull bar with a body about the same size and a close at the top. If we're talking about a 5-minute chart, if you look at that same chart on a 10-minute chart, you might see a perfect bull reversal bar. When the reversal takes place of a 2 bars, it's a 2-bar reversal, and the 2 bars do not have to be consecutive. You can have a big bear trend bar, and then 5 or 6 bars later have an equally big bull trend bar, and that is a 2-bar reversal, even though they're separated by many bars. And if you go to a high enough time frame chart, you'll see a perfect reversal bar. So you may have a 5-minute bar, bear bar, and then 30 minutes later you might have a very large 5-minute bull trend bar, and if you look at the 30-minute chart, you may see a perfect reversal bar. Here's an example. Here's a small 2-bar reversal. There's a bear bar and then a bull bar, and traders will buy above the high of that bull bar, treating it like a single reversal bar. And if you look on a different time frame chart, for example a 10-minute chart, maybe a 7-minute chart or an 8-minute chart, you'll see a perfect reversal bar. And then also we have a bear spike going down for 3 bars, a bull spike going up for 4 bars. This is basically a 2-bar reversal pattern. And if you look on a high enough time frame chart, this will appear as a single perfect bull reversal bar. Here's an example of a 2-bar reversal sell signal. There's a bull trend bar breaking out above a prior high, followed by an equally strong bear signal bar closing on its low. So these 2 bars create a sell signal pattern setup, and you treat it like a signal bar, and you would short 1 tick below the low of that bear bar. So you treat a 2-bar reversal exactly as you would a perfect reversal bar, a perfect 1-bar reversal bar. Signal bars need context. A strong signal bar is not enough reason to take a trade. The context has to be right. It has to make sense that you'd be expecting a breakout at this particular moment. For example, in a trading range, you want to buy low, sell high, and scalp. You don't want to buy near the top of the range. You don't want to sell near the bottom of the range. So for example, if you see a perfect bull reversal bar, but it's at the top of the range, it's a great looking bar, but the context is bad, so the setup is bad. Remember, most breakout attempts fail, so no matter how strong and convincing the bull signal bar is, and no matter how strong and convincing the bull rally is that took you to the top of the range, 80% of the time the market's going to reverse, and that perfect bull signal bar at the top of the range will result in a losing trade. In a strong trend, you don't want to be looking for reversals, since most will fail. 80% of reversal attempts in a trend will fail, and you only want to trade with the trend. If the trend is a channel with very broad swings up and down, a lot of two-sided trading, you can take trades in both directions. But if it's a strong trend, a spike, a breakout, you only want to be trading in the direction of the trend. If you want to be selling in a weak bull, in other words, if you want to be selling in a channel, you need prior selling pressure. I talked about selling pressure in another module. And you also want to see a strong sell signal bar. So whenever you're trying to sell in a bull trend, even if it's a weak bull trend, you want to see both selling pressure and a strong sell signal bar. If you want to buy in a weak bear trend, for example, if you have a broad bear channel, you need prior evidence of buying pressure, and you also need a strong buy signal bar. So whenever you're buying in a bear, you need both prior buying pressure and a very good signal bar. Otherwise, don't buy in a bear trend. Here's a perfect example of very good looking bull signal bars, but the context is bad. Here's an example of very good looking bull reversal bars right here and again here, but the context is bad. The market's in a trading range and you're right at the top of the trading range. So when the market's in a trading range, you don't want to be buying at the top even if you have a great looking bull reversal bar. Here are a couple more very good bull reversal bars. And again, the context is very bad. You're in a very tight channel, a very strong bear channel. So it's a strong bear trend, and you should not be looking to buy above bull bars even though they're perfect. There's no prior significant buying pressure. And you only want to buy in a bear trend if you have, one, a good signal bar, you have it, and you have it here. But you also want significant prior buying pressure, and there was no significant buying pressure in this sell-off. Sometimes the context is just not all that clear. For example, here maybe this is a major trend reversal, but maybe it's a trading range. If it's a trading range and the market's going down for 7 or 8 bars, you might want to wait for a second signal before you buy. So you have a great looking signal bar, but you're not sure about the context. So when in doubt, it's usually better to wait. Here's a situation where the signal bar is okay. It does not have a big bear body, but the context is pretty good. We have a channel with pretty good selling pressure along the way. There was a big pullback here, a two-legged pullback here, a strong bear spike earlier in the day. We reversed up after going below the low of the day, so we may be reversing down above the high of the day. This might be a trading range day, so that might be worth taking a short. Whenever the setup is weak, you need a very strong signal bar. For example, when you're buying in a bear, you need a very strong signal bar. But you also need good context when you're buying in a bear trend. You need prior buying pressure. Strong setups do not require strong signal bars. For example, you can have a strong trend and the signal bars in the direction of the trend are often bad. So you could have a very good buy setup, but a very bad signal bar. And that's okay. If the trend is strong enough, you do not need a strong signal bar. But you certainly do not trade against a strong trend, even if you do have a strong signal bar. For example, here's a bear trend and a very good looking buy signal bar, so it's a strong signal bar. And you have pretty good context. You have a low 2 short, 2 pushes up here and here. Second attempt down, here's the first attempt down. It went below the low of the prior bar. And then we went below the low of the prior bar again here. So we got some buying pressure going on. We also have tails on the bottoms of the bars. We have a possible sell climax here. So the context, I think, is supportive of a possible reversal back up into this potentially final flag of the sell-off. and then on top of that we have a very good signal bar. So this is a circumstance where there's a strong signal bar and a bear trend, and the context is pretty good. We might have a final flag setup which could lead to a failed breakout and a reversal up. Strong trends often have terrible looking signal bars, and that's okay. The stronger the trend, the less important the signal bar. Though, if you're going against a strong trend, you need an incredibly strong signal bar. But if you're trading in the direction of the trend, a lot of times the signal bars will be bad. Here's a doji, here's a bear bar, here's a small bull bar, here's a doji, here's a bear bar, a small bull bar. You got a bear bar here. You could even buy above that, the first close below the moving average in a very strong trend. Another bear bar and strong leg up. So when you have a very strong trend and you're looking to buy, don't worry about having perfect signal bars. If you wait for perfect signal bars, you won't take any trades. Because if you look at this trend, there were really no great looking signal bars. Maybe the outside up bar here. So when the trend is very strong and you're trading in the direction of the trend, don't worry about the appearance of the signal bar so much. When you're buying in a bear trend, here we have a sell-off. It's a bear channel. A bear channel is a bear trend. We're following a pretty good bear bar. You want to see a pretty good reversal bar. Incidentally, this is an expanding triangle, five-legged pattern, down, up, down. So 3 pushes down, and that's a pretty reliable reversal pattern, especially when you have a pretty strong signal bar. I consider all expanding triangles to be as strong as major trend reversals. We had a bear channel down to here, a small break above the trend line which is not drawn in, and then we have the reversal. If you have a weak setup, remember the setup is both the signal bar and the context. It's better to wait. However, sometimes you can trade depending on the circumstances and depending on your trade management. If you have a weak setup, what should you wait for if you're choosing to wait? You can wait for a very strong breakout. You can wait until the market is clearly always in your direction. Or you can not take the first entry and wait to see if a couple bars later the market creates a second signal. So in other words, you go for the second entry and not the first. Here's weak context. We have a very tight bear channel, 8 bars down, 8 bars without a pullback, 8 bars with highs below the high of the prior bar. So there's no prior buying pressure. And the signal bar is a bear bar. Close above the midpoint, yes, so it's a reversal bar, but not a bull body. So that is not a strong signal bar. So we have bad context and a bad signal. So it's better not to take that first attempt up. Okay, so you miss the first entry. However, what's going on here? We have a strong bull bar for those who did take it, closing on its high, and then a second strong bull bar closing on its high, and an even bigger body. And beyond, so it's a breakout bar, and then there's follow through on the bar afterwards, another bull body. So at some point during this rally, traders have decided that, yeah, this is a bull trend. Even though we did not have a good buy signal, we have a very strong breakout, and the market now is always in long. So traders will be buying as the spike is going up. They'll be buying the close of this bar. They'll be buying the close of this bar. So you waited for a strong trend, and yes, even if you bought here or the close of over here, you missed the beginning part of the trend. The probability is so high at this point that the market will go higher that it's perfectly good to buy, even up at this point. Your stop would be below the bottom of the spike. Okay, so you waited for a strong bull breakout and follow through. In other words, another bar up after that. So when you have that, the always in situation has reversed from a bear trend to long. So now you have a strong bull trend. A bull breakout. A bull breakout is a strong bull trend, and you can buy for any reason, including buying at the market. I have a module that talks about how to trade bull breakouts. In other words, how to trade strong bull trends. So somewhere in here, more and more traders decided that the market was always in long. And when it's always in long, you buy for any reason. You buy at the market. You buy the close of a strong bar. You buy below the low of a prior bar. You buy pullbacks. So bear reversal bar, but the context is bad for the bears. We have a very strong bull breakout. So traders will place limit orders to buy at the low of that bar, and they'll get filled one tick below its low, or excuse me, they'll get filled at its low on this bar. And they'll place orders to buy above bull bars. Here's a pullback, a bull flag, an II pattern, an IOI, inside, outside, inside, and an II, closing on its high tick, so they'll buy this. Another strong close, they'll buy that. Possible 3 pushes up, 1, 2, 3. Possible final flag after a buy climax, and then they see a bear inside bar. They might take profits on the close of that bar, or maybe one tick below its low. So if you don't get the strong breakout, you can get a weaker breakout, and you decide that the market has reversed to an always-in trend in the new direction. So for example here, the context is good, maybe a trading range day and a new high. Signal bar is not all that good. So you don't have to take the short below the low of this bar. You can wait to see if the market becomes always in short. Maybe we'll get a very strong bear breakout bar. That could flip it to short. Maybe we'll get a series of bear bars. That could flip it to short. So if you wait for more information, you can get a much higher probability trade. Alright, at this point we have 3 consecutive bear bars, each one bigger than the last, and we're reversing down from a new high after reversing up from a new low. So this might be a trading range day. Now we have 3 consecutive bear bars. Traders at this point are starting to think that the market is going lower. Even if it goes above the high of this bar, they think it's going lower. So at this point the market is always in short because you think that it's going lower. So you could start looking to sell. You could sell the close of this bar. You could sell if the market goes above its high. So here, traders, they could sell closes. They could sell the close of this bar, this bar. They could sell one tick below its low, one tick below its low. They could sell up above the high of this bar. Here we have 6 consecutive bear bars. Almost certainly a reversal will not lead to anything other than a bear flag. So traders will start selling at the high of the prior bar, and they'll scale in higher. Here we have 2 pushes up, a couple bull bars, a bear bar, and then another bull bar. So that's a low 2 short, a 2-legged bear flag. Traders will short below the low of this bear bar. We have a small double bottom here with big tails. Traders would probably start taking profits above the high of this bar. So you can wait for a strong breakout. You can wait for the market to become always in long, or you can wait for a second entry when you have a weak setup. I showed this slide earlier. It's a situation where it's unclear whether it's time to buy. If it's a trading range, we have 7 bars down without a pullback, and therefore it's probably enough selling pressure to make this not a reliable buy. So it's probably better to wait to see if we get a second chance to buy. First entry would have failed. Traders who bought above its high and had to stop below its low would have been stopped out with a loss. But here we have a second decent bull signal bar. So this is a second setup, a second signal. This is a more reliable buy setup. Traders would place a buy stop at 1 tick above the high of the signal bar. So the first signal was above here. Traders get stopped out when the market fell below its low. and the market immediately formed a second equally good buy signal bar. So a second entry in a potential trading range is a reasonable buy for a test up near the top of the range for a scalp. If you decide to trade instead of waiting, the past series of slides had to do with waiting for the market to either give you a second signal to become always in long or have a strong breakout and then enter. Instead, you can just trade right away when the situation is not clear, when you have a weak setup, either a weak context or a weak signal bar. You can trade using your usual approach. You can also trade a much smaller position size, maybe a half size or a quarter size. If you choose to trade small, you have a couple ways to handle it. One is to use a very wide stop. The second is to use your usual stop, and if you get stopped out and then the market gives another signal, you double up your position size on the second signal. So you take a full size position on the second signal. So if you use your usual approach and a normal size position and a stop, and you get stopped out and then you get a second signal, enter again. If you get stopped out a second time, do not take a third signal, because you're probably fighting a trend that is much stronger than you think. So if you're using your usual approach and you have a strong signal bar but an unclear context, you could buy above the signal bar, put a stop below, and if you're stopped out, wait for a second signal and then buy again. That is a very common way to handle this situation. So here's an example. You buy here, you get stopped out when the market falls below the signal bar, and then you buy again above the new signal bar. The other alternative to using your usual approach is to trade very small, like half size, maybe even a quarter size. And if you get stopped out and you get a second signal, then trade a full size position on the second signal. Or you could trade small and just use a very wide stop, so that the total dollars at risk are the same as they would have been had you used your usual approach and traded your usual size and using a smaller stop. So for example, you get your weak setup and you're trading small. Let's say you trade half size on your first entry using your normal stop. If you get stopped out, buy again, but on your second entry, use your normal size. So this is an example. So traders might have bought here, gotten stopped out here, and then buy again, but this time full size. So they buy a half size position here, stopped out, then they buy the full size position here, so that when the market goes up far enough for a profit, the win will more than offset the earlier loss. Another alternative is to use a very wide stop. And if you do, and you trade small enough, and you get a second signal further down, you can add on to your original position. You always want to keep the total dollars at risk the same. So you trade small enough so that you're not risking more dollars than you usually do. Sometimes traders, when they do this, they'll buy more on the second signal. So let's say they bought 100 spider contracts and the market fell 30 cents, and they got a second signal. Maybe they'll buy 200 or 300 on the second signal. Here's that example again. So traders, maybe they bought one E-mini here. This is a 5-minute E-mini chart. And then maybe when they got stopped out, maybe they bought 2 or 3 here. After the market goes your way, you can use a tighter stop, and you're in a position to calculate your actual risk, which is usually less than your initial risk. The actual risk is, after the market goes your way, you look back and you figure out how many ticks would you have had to risk to not have been stopped out. And if you have a smaller actual risk, you can go for a smaller profit target, and you have a higher probability of achieving that target than you do of having a target based upon your initial risk, because you're not looking for as far away. Okay, so let's say you bought here above the signal bar, and you used a wide stop, let's say way down here. Okay, and you originally were looking for a move up equal to the size of your initial risk, right? So that might be up here. However, once the trade started to go your way, right, your stop is down here, you bought here, so you did not get stopped out below here because you were relying on this wide stop. So once the market starts to go up here, at this point, you can look back and say, how many ticks would I have had to have for my stop so that I would not have been stopped out? Well, your stop would have had to be 1 tick below this bar. So you bought here, and at this point, the actual number of ticks that you risked was from your entry price here down to 1 tick below this bar. So you could base your profit target on your actual risk, entry price to 1 tick below the low of the move, instead of on your initial risk. And so you can try to exit at a measured move up based upon the actual risk to your entry price, which was up here. Whenever you have a weak setup and you're not quite sure if it's strong enough, it's usually better to wait. When you're in doubt and you think it might be okay, then only buy if you have a very strong bull signal bar, and only sell below a very strong bear signal bar. Here's the situation. Context not all that great. Signal bar is weak, only a 1 tick bull body or a very small bull body. Better to wait and not take the trade. Here we have a bigger bull body, and the context is good. This is a higher low major trend reversal. So that is a more reliable signal bar. So you could buy above its high or above the high of this small signal bar here. Again, signal bar is not great, but the context became much better. Or you could wait until the market became clearly always in long, and it's starting to close above prior bars. And at that point, you can start buying on closes. This is the end of the module on setups and signal bars. Thank you. I'm Al Brooks, and this is my price action trading course. The current module has to do with pullbacks and bar counting. A pullback is simply a pause in a trend. The trend usually resumes, and the pullback provides a high probability, low risk entry. Bar counting is one method that I use to help find pullbacks. In a strong trend, a pullback oftentimes just goes against the bull for a bar or two. It might be a small inside bar. It may be a bear bar. It may drop 2 or 3 bars. But usually in a strong bull trend, the first pullback only has 1 leg down before the bull trend resumes. In a weak trend, for example in a channel, traders often wait for bigger pullbacks, like pullbacks that have 2 or 3 legs down. Rarely a pullback will have even 4 legs down. An example of a 2-legged pullback is an ABC correction. A triangle is an example of a 3-legged pullback. A wedge bear flag, or a wedge bull flag is another example of a 3-legged pullback in a bull trend. When does the pullback end? As soon as the current bar's high extends at least 1 tick above the high of the prior bar, that is the end of the current leg down. If it's a total of a 1-legged pullback and the trend resumes, as soon as that current bar goes above the high of the prior bar, the pullback has ended and the trend is resuming. With bar counting, I'm counting the number of attempts that the trend makes to resume, and it's the same as the number of legs in a pullback. For example, in a two-legged pullback, an ABC correction, after the first leg down, the market tries to turn up. That's a high 1. The market turns down again for a second leg, and when it tries to resume up again that second time, that is a high 2 buy setup. In a sideways to down market, in either a bull trend or a trading range. Okay, either a bull trend or a trading range, not a bear trend. If the high of the current bar, if the high of the next bar goes above the high of the current bar becomes a high 1 buy signal bar. You can call it a high 1 buy setup or a high 1 reversal. The bar that goes above the high is the high 1 entry bar. That would be the bar in which you enter the trade. You'd place a buy stop 1 tick above the high of the signal bar. The high 1 ends the first leg of the sideways to down move, and it might be the end of the pullback in a strong bull trend. It may be the first leg down in a larger pullback, for example in a triangle or a wedge bull flag. If the market continues sideways to down after the high 1 triggers, the next occurrence of a bar going above the high of the prior bar is a high 2 reversal, and that ends the second leg of the correction. There are lots of ways to do the counting, but you shouldn't lose sight of the goal. The goal is to look for pullbacks to buy in a strong bull trend. For example, a pretty good bull spike, a 1 bar pullback, so it's a potential high 1 buy signal bar. Traders might want to buy 1 tick above the high of that bar. Here, the market turned down again for a second leg, so you can call it an ABC correction, A, B, and C. If the market goes above the high of this bar, that would be going above the high of the second leg down. This would be a high 2 buy signal bar, and it would be a reasonable setup for a long in a bull trend, buying 1 tick above the high of the bar. Here we sold off after 7 or 8 bars up, and the first time the market goes above the high of the prior bar is a high 1 entry. So this bar, this bull bar, is a high 1 entry, and this is the high 1 buy signal bar. So as the market's selling off, traders will place a buy stop to go long 1 tick above this bar, and then 1 tick above this bar, and then they get filled on this bar. Here you could call this a high 2 buy setup because it's part of a larger correction. 1 leg down here, the market went up, and then a second leg down here. Anytime you see a double bottom, you have 2 legs down, and that means it's a high 2 buy setup. You could also call this a smaller high 2 because the market went up to this bar, went down for a small bar, and then up again, and then down again as well. So it's a high 2 with respect to this high 1, and it's a high 2 with respect to this larger pattern, this larger high 1. Another bull spike, a pause, a 2 bar pause. So it's a high 1 buy setup, and here's the high 1 entry bar. 1 tick above the high of the prior bar is where you get long. It went sideways more, so here we have a sideways correction, a down bar, a couple bars up, another down bar. So that's 2 legs sideways to down. So this inside bar is a potential high 2 buy setup, and traders will place a buy stop 1 tick above its high to go long. Another bear microchannel in a strong bull trend, and it's a high 1 buy setup. You could also call this a high 2. We have a bar down here, and then a bull bar, an up bar, and then down here. It doesn't really matter what you call it, as long as you remember the goal. The goal is to find setups that will allow you to enter in the bull trend. Here you might want to wait until we get closer to the moving average, and to see if we get a better signal bar. And here, that's what we have. We have a bull body, which is a better signal bar, so a high 2. You can count it using the pink numbers, high 1, high 2. We went sideways here and had 3 pushes down. A bear bar, up, a couple more bear bars, up, a couple more bear bars. So 3 pushes down. In my mind, I think of any 3-push pattern that's basically horizontal as a triangle, even if it does not have a triangle shape. So the buy setup is above the high of this bear bar. We have a 2-bar reversal here, so you could go long 1 tick above the high of the bull bar. If the trend continues down, the third leg ends with a high 3 reversal, and the fourth leg ends with a high 4 reversal. There are no high 5s. If the market goes beyond a 4-legged pullback, you're probably in a bear trend, and I think you have to give up looking for a trend resumption. What about sideways to up in a bear trend or a trading range? Not in a bull trend, in a bear trend or a trading range. If the low of the next bar goes below the low of the current bar becomes a low 1 sell signal bar. You can call it a low 1 sell setup or a low 1 reversal. If the bar goes below the low of that signal bar, the current bar then is the low 1 entry bar. This ends the first leg up in the sideways to up move, and further legs are setups for low 3 shorts, low 4 shorts. Again, there are many variations on how to count and many acceptable ways to do the labeling. You can't lose sight of the goal. You're trying to find low risk entries in trends or in trading ranges as well. Again, don't lose sight of the goal. You're looking to buy pullbacks in a bull trend. When you're looking to buy a high 2, you're simply looking to buy a 2-legged pullback, an ABC correction in the bull trend. Wedges are 3-legged moves. They're basically triangles that are angled up or down. Anytime you see a 3-push pattern, here we get 3 pushes up, bar 1, bar 2, bar 3. You always got to think about the possibility that it will function as a wedge even if it does not have a wedge shape. So this is a low 3 sell setup. Here's the low 1. Okay, first push up, we went below the low of the prior bar. Second push up, we went below the low of the prior bar, so a low 2. And a third push up, the entry is 1 tick below the low of the signal bar, so traders would go short on this bar. When we traded down, basically a trading range, remember. So you can short a low 3 at the top of a trading range. You can buy a high 3 at the bottom of a trading range. We had a leg down. The market went above the high of the bar, so that's the high 1. A second leg down. The market went above bar 2 over here, so that's a high 2. And then we had a third leg down, and when the market went above the high of this bar, it formed a high 3. The third leg down subdivided into even a smaller wedge. 1 push down here, second push down here, ending with a bull bar, and then a third push down. So there's a nested pattern. There's a wedge inside of a larger wedge. Double tops and bottoms. All double tops are low 2 sell setups. Anytime you see a double top, just think of it as a low 2 sell setup. Anytime you see a double bottom, think about it as a high 2 buy setup. And don't enter unless the context makes sense. If you're in the middle of a tight trading range, you're going to see lots of high 2s and low 2s, and you should not be taking the entries. The context has to make sense. All double tops are low 2 sell setups. For example, the market went up here and went down. It tried to reverse up here, and instead it double topped and turned down. So there's a 2-bar reversal up and down, and it's a sell signal below the low of that bar for the low 2 short. You could short below the bull bar, but in general I prefer to short below bear bars. Market went sideways up a little bit, so there's a third push up here, bull bar, up here, another bull bar, up here, third bull bar, so 3 pushes up. That's also a triangle, and here there's a bear inside bar for the signal bar. So you can call it a low 2 short below bar 2, or you can call it a triangle below bar 3. Here is a double bottom. The market had a strong bull spike, 6 consecutive bull bars, a good sized bull bar, a weaker sell-off, overlap, bull bar, sideways in here, and we have a low and a double bottom. So double bottom is a high 2. This is either a trading range. It is a trading range for sure, but it could also be the start of a bull channel. So you're looking for high 2 buy setups in trading ranges or bull trends, and that's what this is. This is either going to be a bull trend or a trading range, so buying a high 2 makes sense. And there are other ways to count. So instead of calling this bar 1, you call this bar 1. The market tried to resume up here and then had a two-legged pullback here. So it doesn't matter if you call the high 2 these 2 bars or this bar and that bar for the double bottom. Over here I mentioned earlier that we have a double top, so a low 2, and then we had a third push up, and that makes this a low 3 sell setup in a bear trend. And what about high 4 and low 4 setups? When a pullback lasts so long that you're wondering if the pullback has turned into a trend in the opposite direction, after a high 3, for example, start looking for a high 4. Same thing in a bear trend. If the pullback goes on for a long time, start counting to see if there's a low 4 sell setup, because a lot of times you'll get a good resumption of the trend from a low 4. Many pullbacks are in channels, and the channels often end with 4 legs. For example, a pullback in a bull trend oftentimes goes down 4 legs, forming a high 4 and then a rally. A pullback in a bear trend oftentimes goes up 4 legs, and that is a low 4 sell setup for resumption of the bear. A lot of times a high 4 is just a pair of back-to-back high 2 setups. So you get 2 legs down, high 2, and then a rally, and then another breakout and another 2 legs down. And a low 4 in a bear trend is often a pair of consecutive low 2 patterns. So you go up once in a bear, and then twice, and then you start to resume, and then you get a bear breakout, and then another 2 legs up, and that's a low 4 sell setup. Here are examples. On the left, we have a strong rally, so traders are looking to buy pullbacks. They could buy the high 2, that's reasonable, but instead of the market resuming upward, we got a downside bear breakout for 2 more legs. So now we have 4 pushes down. We have a bear bar here for 1 push. We have a second push down here, a third push here with these 3 bear bars, and then a 4th push down with these 3 bear bars. So you can call it a high 2, and then a breakout and another high 2, or you could simply count it as a high 4, high 1, high 2, high 3, high 4. And you always have to be thinking about high 4s when you have a channel correcting in a bull trend. As long as the market's staying above the bottom of the bull spike, it's still always in long, unless we get some strong sell setup in here, which we do not have. So it's still a bull trend, so you're looking to buy pullbacks. And don't give up after the high 3. It's not a very good looking signal bar for the high 3 anyway. Don't give up after the high 3. As soon as you see the 4th push down, you place a buy stop 1 tick above its high, just in case you get something like this. In a bear trend, same thing. We have a trend down, and we have a pullback to the moving average, an attempt to resume, a low 1, another pullback. So now we have an ABC, 2 pushes up, A, B, C, so a low 2 sell setup, and the breakout attempt with this bear bar immediately reversed back up, and we have a 3rd attempt, and now we have a 4th attempt. You can short either below that bull bar or below the low of this bear bar if you want to treat it like a 2-bar reversal for a low 4 sell setup. So it's back-to-back low 2s. There's a low 1, low 2, and then a second low 1, low 2, or you can simply call it a low 4 sell setup. This is the same chart, but a 15-minute chart, and that low 2 that we just saw on the 5-minute chart actually is just a simple low 2 on the 15-minute chart. Once you have a breakout and the trend resumes, you start the process over. You're looking to buy or sell, depending bull or bear trend. You're looking to enter on the next pullback. So with each breakout, you start looking for another pullback, and you start the count all over again. if a pullback keeps growing, like if you have a bull trend and you have a pullback and you have a high 4 that forms and the market just keeps trending down, the pullback can become a trend in the opposite direction. For example, here's Treasury bond futures, a huge bull spike, huge follow through, so traders are looking to buy a pullback. Pretty climactic, might be an exhausting gap. We got one push down, a second push down, and a third push down to the moving average, and it's a very nice looking wedge bull flag. Traders could buy above the high of this bar, or they could take a second entry, which is buying on a stop above the high of that bar. It's also a moving average gap bar. The high of the bar is below the moving average, and that's usually a fairly reliable buy signal for a pullback in a strong bull trend. But look what happened. The buy stop above the high of this bar never got hit, so the bulls never went long. Instead, the market started to sell off more. Here we have a bull II. We have an inside bar and a second inside bar, and it's a bull body. You can count it as 3 pushes down. 1, 2, 3. So we had the breakout here with 3 pushes down. 1, 2, 3. So you can try to convince yourself that it's a small wedge. But when the channel down is this steep, I would not buy until after the market had a strong bull breakout and then a pullback. So I would not buy above the bull II. And this is what happened. That bull II became a low 2 bear flag. Push up here, so low 1, and second push up here, low 2. So you would short below the low of that bar, test of the moving average. Double top with this bar, so you can call it a double top, you can call it a triangle, you can call it low 2, doesn't matter. Here's a push up here, second push up here, second push, third push here, so a triangle. Doesn't matter. You'd short with on a stop 1 tick below the low of that bar, and your initial protective stop is 1 tick above the high of the bar. And your initial target, you might want to go for 1 time the risk. The risk is so tiny, I would not go for that. You might want to go for 2 times the risk. I wouldn't go for that. The risk is so tiny, I would wait to see what the breakout looks like. We have a good breakout bar here, second breakout bar here, third breakout bar here. It looks like the market is capitulating and deciding that it's no longer a bull trend. So with these 3 bars, I think traders stopped looking to buy a pullback and instead became convinced that the market's always in short. So now they're looking to sell rallies. For example, here's a pullback, 1 bar up after the 3 bar bear spike. Traders would short that as a low 1. Second push up, double top, the high of this bar, the high of that bar. Double tops are rarely exact, but 2 pushes up create a double top, a low 2 sell setup. A pause bar here, you can argue this is a small triangle, a triangle sell setup. The height of the spike, let's say you sold this close. Your stop is going to be 1 tick above the high of the spike. So up here at this gray line, that's your initial protective stop. Your initial target, you might want to go for 1 time the risk, which would be here, thinking that it's now a clear bear trend, so that means 60% probability. 60% probability, you can go for a target that's just equal to your risk. If you want, you can try to go for a target that's twice your risk. You can sell closes, you can sell the low 1, you can sell the low 2, you can sell the triangle. It doesn't matter. Your initial protective stop is up here. And again, if the move goes down too far, you start the count over again. You can call this a low 1 because of this pullback. You could also call it a low 2. The market went up here, down, and up a second time. The market traded down again, broke to the downside again. So at this point, I would start the count over again. We have 2 bars up, so this is potentially a low 1. A second bar up over here, potentially a low 2. You could call it a low 1 as well. No pullback. The market did not trade below the low of the prior bar, so you could say it's a small bull microchannel and therefore a low 1. Doesn't matter. You're just simply looking to sell a pullback, and here we have a pullback to the moving average. And on a smaller time frame, you can see that it's subdivided into a low 2. Push up and down with this tail, and then up again. So bear trend a pause at the moving average, low 1 or low 2, a reasonable short. In a strong bull trend up here, you only want to look to buy. Remember, a low 1 and a low 2 is for shorting in a trading range or in a bear trend, not in a bull trend. So you can look at this and say, well, we're in a trading range all through here, and therefore we should short a low 1 or a low 2. Except that we're no longer in a trading range here. When you start to see a strong bull spike like this, the market's breaking out, and at this point it's a strong bull trend. So in a strong bull trend, you don't think about shorting, so you don't think about low 1s and low 2s. So you do not take shorts here. You should also be thinking about higher time frames. Sometimes the market can be in a trading range on the 5-minute chart, lasting for hours, but it may simply be forming a high 2 buy setup on the 60-minute chart. And if you're aware of that, you can spot an early entry on the 5-minute chart, an entry earlier than what you would take on the 60-minute chart. For example, here's the 5-minute chart, a big sell-off, and then a rally, and then another big sell-off. Okay, double bottom is always a high 2, and you can say, "Well, Al, I don't want to buy this." Well, you can also view it as a triangle. 3 pushes down, 1, 2, 3. You can view it as a breakout pullback buy. We have the high 2 buy here, and then the market continued breaking out to the upside, pulled back, and had a bull reversal bar. Bottom line, it's basically a large 2-legged correction. A sell-off here, the market attempted to resume through here, and then sold off again. So this is a large high 2 buy setup. And on the 60-minute chart on the left, that's what it was. This whole thing that we see right here on the 60-minute chart is just these 5 bars pulling back. We had a push below the low of the prior bar, 1 leg down. The market tried to resume, and then we had a second attempt down. And on the 60-minute chart, we have a bull signal bar. We have a gap up and 4 bars up, so a pretty strong bull trend. So traders will buy high 2s. They'll look to buy above the high of this bull bar on a stop, 1 tick above. You can enter earlier on the 5-minute chart, either above this bear bar, which I would not, but above this bull bar, I think it's a reasonable buy. And this is what followed. The market went up to the upside pretty strongly. On the right, you can see the 5-minute chart, and on the left, you can see the 60-minute rally that followed the high 2 buy setup. You also have to be thinking about lower time frames. Sometimes the market will be forming a high 1 on a 5-minute chart, but it might be forming a high 2 on a 1-minute chart. So you can infer what's going on a lower time frame chart or what's going on the 5-minute chart. So for example, we have a gap up and then 2 very strong bull bars, and we're starting to correct sideways. The market did not get above the high of this bar. It finally got above the high of this bar. You can call this a high 1 buy setup, the first time the market went above the high of the prior bar. But you can also say, wait a minute, it went down on this bar, and then up here, and then down again, another bear bar. So you know that on a smaller time frame, there was a high 2 buy setup. There were 2 legs down, up, down. You don't even have to look at the 1-minute chart to see that this is a smaller time frame high 2 buy. Here's the 1-minute chart. It's a very strong bull spike. 1 push down, tried to resume. 2nd push down, double bottom, high 2 buy setup. I would not bother, looking at the 1-minute chart. You can infer it based on the 5-minute chart. High 1 or high 2, it doesn't matter what you call it. You just have to understand what's going on. You're looking for small pullbacks to buy in a bull trend or in a trading range. Okay, again, this is what I was saying about this 5-minute chart. You can call this a high 1 because the market never triggered a prior high 1. It did not get above the high of this bar. So this is the first time the bull is resuming, so you can call it a high 1. Or, like I said, you can infer that, hey, wait a minute, there were 2 pushes down here. It went down, up, and down, so you can call it a high 2. Again, it doesn't matter. You just have to look at this and say it's a strong bull trend, and therefore you want to buy above the high of the prior bar to catch the resumption of the trend with small risk. So you buy above up here, and your stop is here, so you have small risk and probability. And why does a high 2 work and why does a low 2 work? Because when trading a counter trend, most traders will let the market go against them once, but they'll not let it go against them a second time. Okay, how does that translate into what's going on with a high 1 or a high 2? Okay, and a bull trend, okay, if you're getting a pullback, a high 2 pullback is a second attempt to resume the bull trend. And if you're short, most bears will get out. The market made 2 attempts to go down, 1 and 2, and if it now goes up, the bears will give up. So the bears will get out when the high 2 triggers. And bulls, if they're flat, they'll buy at the same price. So you have the bulls buying to get long, and you have the bears buying to get out of shorts. So there's nobody left to sell, and that makes high 2s reliable buy signals in bull trends. Okay, both the bulls and the bears are buying. There's no one left to sell at that price, so the market has to go higher to find sellers. In a bear, a low 2 is the second attempt to resume the bear trend. If a trader is long and the market, if the person's bottom picking and they're long and the market goes up and then triggers a low 1, they might hold long. If it goes up again a second time and turns down a second time, triggering a low 2, most of those early bulls will exit. They would have given the market 2 different chances to go up, and if it failed both times, they would be concerned that the bear would be resuming, and they would exit when the low 2 triggered. Bears who are flat, they'll enter on the low 2 looking for a resumption of the trend. Okay, so you have both the bulls and the bears selling, no one willing to buy, so the market has to go down, and that makes a low 2 a reliable sell signal in a bear, because the bulls are selling out of their longs and taking their losses, and the bears are selling to capture the resumption of the trend. So for example, in a bear trend, big gap down, market selling off, the bulls might buy above this bull bar. And then they may hold with the stop below the low of the bar, and they'll allow the market to go against them one time. It did right here. And now the trend is resuming again, and they're getting pretty excited. They had 3 bull bars here, strong bull bar here, 3 bull bars here. So the bulls are getting pretty excited that they may be capturing the low of the day. However, this next bar, a bear bar closing on its low, the bulls won't hold any longer. They'll look at this and say, well, it tried to go up here, failed. Tried to go up here again, it looks like it's failing if it gets below the low of this bar. So the bulls will get out below the low of this bar. Bears will short here for a scalp, betting that it's a reliable, high probability sell setup. And there was enough room down here for a scalp. And that is the end of this module on pullbacks and bar counting. Thank you. This is Al Brooks, and this is my price action trading course. The current module is about channels. The market is in a channel whenever you can draw 2 lines that contain the bars on the chart. And any pair of lines that contains a section of the chart is a channel. The lines can be parallel, they can be convergent, and they can be divergent. The channels can rise like in a bull channel, a bull trend, and the channels can fall like in a bear channel, which is a type of bear trend. A channel is a weak trend. It's a trend, but it's weak. It's not as strong as a breakout. Trends can either be breakouts, very strong, very vertical, or they can be channels. And a channel is a weak bull trend. It can still be very steep and strong, not as strong as a breakout. There's a bull trend line below and a bull trend channel line above. And a bear channel can also be very steep and down, almost as strong as a breakout, but it's still a form of weak bear trend, weak compared to a breakout phase, a spike phase of a bear trend. There's a bear trend line above and a bear trend channel line below. You only need to see one of the 2 lines to know that the market is in a channel. As soon as you see either a trend line or a trend channel line, the market's in a channel. Even if the channel doesn't look right, even if it doesn't look conventional, there's always an opposite line, even if you don't see it. As soon as you see one line on the chart, assume that there's a channel and that there's a line that you could draw. Here you could draw it above here. Ultimately, you could draw it above here. So even if the second line is not evident at the time you see the first line, the market is in a channel. Here you can see a trend channel line, so the market might be in a channel. And then you look on top and you think, well, where does the second line go? Does it go down here? Does it go across here? If it goes across here, it looks like it's divergent and too broad. That doesn't look right. Well, the market's always in a channel, so you always have to look at any possible line and accept that it may end up working as the other side of the channel. Okay, so this is the only obvious choice for the top of the channel. The lines are not quite parallel. This line has a flatter slope, so they're somewhat divergent, but it's better to assume that this will contain the price action and that this is a channel until proven otherwise. And here you can see that the market came up and hit that line, and now it looks like this line is a possible top of the channel. After every failed breakout of either line, the top or the bottom of the channel, once the market reverses into the channel, you redraw the line using the extreme point of the breakout that went beyond the channel. Channels tend to get flatter, more horizontal. They tend to get broader. The lines tend to get further apart. And eventually the channel evolves into a trading range. So here's that initial bull channel. The market broke out to the top. As soon as it reverses down, you draw another line. The market here went above that first line. It reversed down, so now you draw another line. And here, I didn't extend this line forward, but we broke above it, so now you look to draw another line. And you can see these lines are becoming increasingly flat. The channel is losing momentum, it's becoming flatter, and eventually it will evolve into a trading range. When the market gets to the top or bottom of a channel, it offers traders trading opportunities. The market can break out and enter a breakout phase, a strong trend phase, or it can reverse. In either case, you can find trades where the reward is much bigger than the risk. So you tend to have excellent traders' equations near the top and bottom of the channel. The easiest thing to do is look for a reversal and enter on the reversal, and then expect the market to test the opposite side of the channel. Remember, the market's in a never-ending cycle. It's in a trend, either a breakout phase or a channel phase, and then it enters a trading range, and then from the trading range it breaks out again in either direction. So then you are back to the trend phase. As part of the market cycle, you have the breakout and then the channels usually evolve and become parts of a trading range. A channel is a hybrid. It's a transition between the strong trend phase, the spike phase, the breakout phase, and the trading range phase. Most bull channels should be thought of as bear flags, because most bull channels that go up and to the right, break out to the downside, and they function exactly the same as bear flags. So whenever you see a rising channel, you should always be thinking of it as a bear flag, even if it's part of a strong trend. You have to expect ultimately it'll break out to the downside. It may break out of the upside first, but ultimately you look for it to break through the downside. Bear channels that go down and to the right, whether or not they're part of trends, you should always think of them as bull flags, because most of them ultimately break to the upside. So they're functionally identical to bull flags. Okay, here's a strong bull trend. and the channel itself is fairly strong, fairly tight. Pullbacks are not very big, but it's a channel, and it's a rising channel, a bull channel. Functionally, it's the same as a bear flag, so you have to be looking for a downside breakout, and that's what's occurring as we go sideways. So even the strongest type of a channel is functionally the same as a bear flag, and you should look for a downside breakout. This is that same strong bull trend with the bars compressed so that you can see what took place afterwards. So even a strong bull trend like this, if you have a strong steep channel, you should assume it'll function like a bear flag. It went sideways to break out below the bottom of the bear flag. Ultimately, it broke to the downside, and then the trend started to resume. Channels usually are followed by trading ranges, and when you look at it after the trading range has formed, you say, it was actually part of the trading range. So here we have a trading range all the way across the screen, and the trading range began somewhere over here. Even though as the market was going up at this point, it was part of a bull trend, it was in a channel, and the channel ultimately usually becomes part of a trading range. Bear channels, same thing. Pretty strong bear trend, but a bear channel, so you should assume it'll break to the upside and function like a bull flag. And here we had a very strong upside breakout. And ultimately, a channel is usually followed by a trading range. If I remove these lines from the chart, you would look at this entire area as a trading range. So the channel evolved into a trading range. This channel, at this point, it's part of a bear trend, but at this point, you look at this channel and you say it's part of the trading range. As part of the market cycle, trends evolve into trading ranges evolve into trends. Within trends, the market starts as a spike or a breakout. Once it starts to develop pullbacks, there's some two-sided trading taking place, and it enters a channel phase. So let me talk about a bull channel transitioning into a trading range. Early on in the bulls are holding for swings. They expect the market to go much further. Early on in a channel, the bulls still expect the market to go much further. And they also trade primarily for swings, holding for a big move. As the channel goes on after 10, 20, 30 bars, the bulls start to become concerned that there may not be much left to the trend, and they start taking profits sooner. So they start buying and then scalping out, causing small pullbacks. Buying, every time it goes up, they sell. And all of a sudden you start to get more and more bars with tails on the top and more sideways price action. Bears start to see that there's maybe a potential for profit if they sell. And initially they start to sell for scalps. And so they sell for a little push down. They buy back for a profit. And the bulls also, after they scalp out, they put their scalp back on the sell-off. And the result is another push up. Eventually you get some kind of topping formation, like a major trend reversal, and then the bulls stop buying on the pullbacks, and the bears stop taking profits. They hold for swings, and you can get a trend reversal. But initially, the bulls change from swinging to scalping, and that's usually the beginning of the transition from a bull trend, a bull channel, into a trading range. So here's an example. There's a bull spike, and then a channel. There were spikes within the channel, here and here. At some point, the bulls become uncertain that there's much left in the trend, and they start taking profits. So instead of holding for a swing here or here, they're selling out at the new high, and you're getting a reversal down. Once the bears start to see the bulls taking profits, the bears are more willing to sell for scalps. At some point, the bears are willing to hold more of their position for a swing, and they did get a small bull breakout here. So initially the bulls are swinging during the trend phase, the strong trend phase, the breakout phase. As the channel goes on, more and more bulls become less willing to swing, and they begin to take profits on their earlier positions, and their new positions they tend to treat as scalps, and they take profits more. And that results in deeper pullbacks and a broader swing and a more sideways market. And the bears begin to scale in. So they might sell here and sell more higher. And the bears become stronger, the bulls become weaker, and the result is a trading range. And the opposite is true with a bear channel transitioning into a trading range. A bear channel is part of a bear trend. The bear trend begins with a bear spike, and then it begins to have pullbacks and enters a channel phase. After a certain amount of time, maybe 10, 20, 30, 40 bars, the bears become less confident that there is much left profit to be made by going short, so they begin to take profits on their swings, and any new position that they take tends to be more of a scalp. So every time the market goes down, bears begin to buy. They buy back their swings and they buy back their scalps, and that creates tails on the bottoms of the bars, and the market starts to go more sideways. When the bulls see the profit taking by the bears, they begin to see the potential to make a profit buying for scalps. Every new dip, every new low, they buy for a scalp up. At some point, if there is a reversal pattern, maybe a final flag or a major trend reversal, the bulls will hold more and more of their position for a swing, and the bears will stop looking to sell again on the next rally. So here's an example. We have a bear trend. Within it there were spikes. There was a small spike here, and then a channel, and then a bigger spike, another spike, and a weaker channel. You could argue a bear leg here with a trend line break and a lower low major trend reversal, or a wedge bottom. In any case, we had a very strong bear here, and we started to channel down here, and you can see tails on the bottoms of the bars, strong reversal bar here, another one here. So that means the bears are beginning to take profits at new lows. So the bears who sold up here, the swing bears, they're taking profits. The bears who sold in here, they're taking scalping profits. So more and more profit taking by the bears. And the bulls are seeing these rallies, and they're deciding that, if I buy, I can make at least a scalp. When they see the wedge bottom, the major trend reversal, they think, well, maybe I can even buy for a swing. So the bulls are more willing to hold and add on to the position as the market goes up, and the bears stop selling. They think the bulls have taken over the market, and they're right, and we get the breakout. Ultimately, we had another higher low major trend reversal, and the channel evolved into a large trading range. But the major trend reversal, the bottom, resulted in a move up and another move up large enough for bulls to make a swing profit. Rarely you'll have a bull channel going up to the right that has an upside breakout that is successful and has a lot of follow through, and it will run far enough up for a profit if you're buying. Rarely you'll have a bear channel that will have a downside breakout, and the bear trend will accelerate, and the breakout will be strong enough to allow traders to make a profit by taking shorts. Here's an example. This is the monthly spider chart, basically the monthly S&P 500. We had a strong bull trend, and it evolved into a channel, and instead of the channel breaking to the downside and forming a trading range, we had an upside breakout with a follow-through for about a year. So we had a successful upside breakout of a bull channel. And the trend became a stronger trend, a steeper trend. With trend, breakouts of channels usually fail within about 5 bars. So if you have a channel running up and to the right, and then it breaks to the upside, usually the upside breakout fails within a few bars, maybe 5 bars, and the market reverses back down into the channel and goes all the way down to the opposite side of the channel. A with trend breakout of a channel, usually the start of the evolution into a trading range. The upside breakout of a bull channel usually fails, and then the market reverses down. A downside breakout of a bear channel usually reverses up, and then up into the and sideways, and the channel becomes part of a trading range. The upside breakout turning down or the downside breakout turning up, both are failed attempts to accelerate the trend. And if you see a reasonable signal bar on the reversal, you can usually get a reliable reversal trade that will carry down to the opposite side of the channel. Here's an example. We have a bull channel. The market tried to break out of the top of the channel, but we got a tail. Remember, a tail is a failed breakout attempt. So the market's reversing back into the channel. Not much room for a short here, but the market did make it to the bottom side of the channel by going sideways. The minimum target when you have a failed upside breakout is one tick below the bottom of the channel, which we achieved right there. The market then usually transitions into a trading range, which it's done right here. Here's another example. We have a bear trend channel line, and the market broke below the bottom of the line, a tail, so failed breakout. We have a bull inside bar here, possible buy setup, actually a possible higher low major trend reversal here, and we ultimately went up and tested the top of the channel. The minimum target is one tick above the top of the channel. Sometimes you get a very strong breakout like this, and it can result in a new trend. This trend line at first didn't look like it would contain the price action. The trend channel line was clear. The trend line, the top of the channel, was not clear, but this was the only logical choice for traders, and it turned out to be the actual top of the channel. The market rallied up to it and broke out to the upside. Remember, a bear channel is usually a bull flag, and it usually has an upside breakout. Here the lines obviously are not parallel. Very often lines are not parallel. Okay, again, as soon as you see one of the two lines, here the line below was the obvious one. As soon as you see one of the two lines, assume that the market is in a channel and that there's a way to draw a line on the other side that will probably contain the price action. And this was the most logical location to anchor the upper line. Channels can be very small, even a couple bars. They can be very large and contain all of the bars on the chart. They can also be very broad, with big swings in between, lots of bars going up and down, similar to a trading range, or they can be very tight, very steep, very vertical, very similar to a breakout. Channels can be horizontal. Trading ranges are channels. Remember, any part of the chart that can be contained within two lines, whether or not the lines are parallel, is in a channel. They can be diagonal. A lot of trends are, all trends are up or down, so they run diagonally. Wedges also run diagonally. The lines can be divergent, as with an expanding triangle, and they can be contracting, as with a triangle and a wedge. A wedge is a type of triangle where it's either sloped down or sloped up. The market's always in many channels, whether or not you see them. Many of the channels can only be seen by looking at other time frames. A bull channel on one time frame may be part of a bear channel on another time frame. Every trend is either in a spike phase, a breakout phase, or a channel phase. The spike, breakout, very one-sided trading, no pullbacks, and then that is replaced by the channel phase, where two-sided trading increases and there are pullbacks. Less often, there's just a little overlap of the bars without actual pullbacks. A micro channel, I'll talk about that in another module. What's the minimum requirement for a pullback? In a bull trend, if the low of the current bar is below the low of the prior bar, the current bar is a pullback. It may be a one-bar pullback, or it may be the start of a big pullback lasting many bars. In a bear trend, when the market's going down, if the high of the current bar goes above the high of the prior bar, the market has a pullback. For spikes and breakouts, you should take a look at the modules on breakouts. Remember, spike and breakout are two identical terms. They're interchangeable terms. They mean the same thing, a very strong trend. A spike. Every trend bar is a spike and a small trend. Most of the time, the market ends up going sideways and it becomes part of a trading range. However, it can lead to a trend if the spike is strong and if the context makes sense. Is it logical to expect a trend right now? Channel. As soon as the breakout begins to have a pullback, let's say you have a bull breakout, as soon as it starts to have a pullback, that's evidence of two-sided trading, and it's evidence that the spike phase is probably ending and the channel phase is beginning. And then the channel runs its course and evolves into a trading range. A pullback, it can be as small as a single bar, like in a very strong trend, or it can also contain many bars. And if it contains a lot of bars, the trend is weaker, and it may in fact be the start of a trading range. Once you have a pullback, you could start to form a channel or a trading range, or you could get another spike. So you can have a spike up and then a pullback and then another spike up, or you can have a spike up and a pullback and then a series of stair steps up in a channel. What's the minimum requirement for a bull channel? A series of higher highs and lows. The minimum requirement for a bear channel? A series of lower highs and lower lows. Channels, as I mentioned, are sometimes hard to spot, and beginners sometimes have a hard time seeing channels, especially when the channel lines are not obvious and not parallel. But you got to remember, the market's always in a channel, and as soon as you see either a trend line or a trend channel line, a line above the market or below the market, there is a channel, even if you don't see the opposite side. Again, channels can be very vertical and very tight, almost as strong as a spike, and they behave basically like a spike. They can also be very broad, having big swings, and fairly horizontal and behave more like a trading range. Both are types of trends, but a channel, whether it's vertical and tight or weak, is still a weak trend compared to the spike phase, the breakout phase. Okay, it's still, any channel is still a weak trend, weak compared to the breakout phase. It can be very steep and very tight with the lines close together and the pullbacks very small, and it can behave much more like a spike, a breakout. And when that's the case, it's almost always a spike on a higher time frame chart. And when you have a channel that is as strong as that, you should only take trades in the direction of the trend, even though there's some two-sided trading taking place. Channels can also have lots of swings and be very weak, and like a wedge or a stair pattern. The lines can be far apart. If the channel can be almost horizontal, and when that's the case, it's behaving much more like a trading range, and you should trade it like a trading range. Trade in both directions. When the channel is tight and strong and the pullbacks are very small, the market is extremely one-sided. The extreme example of a very tight channel, a micro channel, where there's a series of bars that overlap, for example in a bull micro channel, but none of the bars falls below the low of the prior bar. So that's a very strong channel. It's still a channel, but it's not quite as strong as a breakout. A tight channel is the strongest type of channel. It's much more similar to a breakout than a trading range. Again, it's a spike or a breakout on a higher time frame chart, and you should only trade in the direction of the trend when you see an extremely strong channel. For example, a tight bull channel. The pullbacks are very small. There's very little selling going on. The bears are in control only briefly and only intermittently. However, there's enough two-sided trading to qualify as a channel instead of a spike. A spike, there's virtually no pullback. A bull spike just goes straight up. A channel might go up and have a 1 bar pullback, and then up again, another 1 bar pullback. Here's examples of tight bull channels. It's not a spike phase because we had a lot of small 1 bar pullbacks. A doji bar here, a bear bar here, a couple of bear bars here. So it's not quite a spike phase. On a higher time frame chart, it would be a single bull trend bar or 2 or 3 bull trend bars on a 15-minute or 60-minute chart. Actually, this is a weekly chart. So on a monthly chart, this is probably a 1 or 2 or 3 very strong bull trend bars breaking out. Here again, strong channels, tight channels, but a slight pullback here, the low below the prior bar. Here there are no pullbacks. So these are micro channels, 11 bars without a pullback. Here 12 bars without a pullback. So it's a tight channel, but I call that a micro channel when there are no pullbacks. Here a tight channel, but there are pullbacks, so it's not quite as strong. This is an extremely common situation when you're looking at a chart and you see a pretty good bull spike here, markets making higher lows and higher highs. Is it going to be a strong bull channel or a weak bull channel? If it's weak and has broad swings, you can trade it in both directions. If it's strong and the pullbacks are very small, you should only look to buy. It doesn't matter. Whenever you look at it and you're not sure if it's weak enough to allow for trades in both directions, only take the buys. When in doubt, only look to buy. Remember, a bull channel is a bull trend. And if you're wondering if it's weak enough to allow for successful shorts, if you have to think about it, don't take the shorts, only take the buys. Up here, we started to evolve into a possible trading range, and we have a strong signal bar. So here I would consider scalping a short. Bull channels can be strong or weak. A strong channel, there's minimal two-sided trading and it behaves more like a breakout, and you should only trade in the direction of the trend, buy. A weak channel, prominent two-sided trading, and it behaves more like a trading range that's tilted up, and you can trade it like a trading range. Buy low, sell high, and scalp. When you're having a hard time deciding whether a channel is strong or weak, assume that it's strong and only look to buy when we're talking about bull channels. Here's an example of a pretty strong bull channel. Pullbacks are very small. You're not going to make any money on the shorts. You should only look to buy. Here, on the other hand, a daily spider chart, big swings, forming higher lows, higher highs, so we're in a bull trend, and we're in a broad channel. But the swings are so big and the channel is so flat, it's much more like a trading range that is slightly tilted up, and you can take trades in both directions. You can buy and you can sell at the top. Weak bull channel. Bull implies trend. Channel implies a weaker version of the trend. Weak compared to the spike phase of the trend. The weaker the channel is, the more likely you can trade in both directions. Weak channels, broad swings, very two-sided. If it's a very tight channel or reasonably tight, only trade in the direction of the trend. What constitutes a weak channel? A broad bull channel. You have overlapping bars. You have weak follow-through, so you'll have a bull bar and then maybe a small bear bar or a doji bar. Many bars with tails on the top, so selling into the close of the bar. Many bars in the channel with bare bodies. You'll have obvious pullbacks where a bar has a low below the low of the prior bar. You may have 2 or 3 in a row, or a pullback that goes down 4 or 5 bars, and you can have big swings up and down. And it looks more like a trading range that is tilted up. Here's an example of a broad bull channel in crude oil, higher highs and higher lows. You can trade that in both directions. A bear channel can be strong or it can be weak. When it's strong, there's minimal two-sided trading, and it behaves much more like a bear breakout, a bear spike, and you should only look to trade in the direction of the trend. You should sell. A weaker channel has more prominent two-sided trading, and it behaves more like a trading range that's tilted down, and you should trade it like a trading range. Buy low, sell high, and scalp. When the channel looks very vertical and very steep with very small pullbacks, it's two-sided. We have some sideways motion, some upward motion, but not enough to make a profitable long trade. So when it looks like this, only trade in the direction of the trend, only sell. On the other hand, when it looks like this, we're forming lower highs and lower lows, so it's a bear trend. It's obviously not a bear spike, so it's a bear channel. You can take trades in both directions. Sell near the top, buy near the bottom. When you can't decide if a channel is strong or weak, a bear channel, assume that it's a strong bear channel, trade it like a strong bear channel, and only look to sell. A very tight bear channel, very small pullbacks, very one-sided, very vertical. There's very little buying. The bulls are in control only briefly and intermittently, only long enough to fulfill the definition of a channel in contrast to a spike or a breakout. Here's an example. You got a very strong spike here. This is a spike, but it's also pretty much of a channel down here. You could argue that the whole move down is a channel, but it's very, very strong. I would not be looking to buy when the market looks like that. Again, a spike and then a channel. This channel is a very tight channel. I would not be looking to buy when the channel looks like this. This is a daily chart of crude oil. Within this channel, there's a spike and then a smaller channel. So you very often get nested patterns where there's a pattern within a larger pattern. This is that same slide with lines drawn in. Remember, anytime you can draw lines above and below the price action, it's in a channel. So this is a channel. It's very tight. The same over here, very tight channel. A weak bear channel. Bear implies trend. Channel implies a weak trend in contrast to a spike or a breakout. Again, the weaker it is, the more likely you can take trades in both directions. A weak channel has very strong, very broad swings, very two-sided market. If the channel instead is reasonably strong and very tight, very small pullbacks, only trade in the direction of the trend. In the case of a bear channel, only look to sell. What constitutes a weak bear channel? You have a lot of overlapping bars. Weak follow-through after a bear trend bar. So you'll have a bear trend bar and then maybe a bull bar. A bear trend bar and two bull bars. You'll have many bars with tails on the bottom, buying into the close of the bars. You'll have many bars with bull bodies. You'll have obvious pullbacks, often with very big swings. And it looks more like a trading range that is tilted down. Here's an example of a broad bear channel, the weekly euro versus the dollar forex. You can see strong bull bars up over here again, but consistently getting lower lows and lower highs. Sometimes you just can't tell whether the market's in a broad bear channel or in a trading range. And most weak channels, most broad channels begin as trading ranges. So very often the market is both within a trading range and in a channel. And the market's transitioning from the trading range into the channel. Once the market clearly begins to form higher highs and lows, then a bull channel is forming, a bull trend, and the market is leaving the trading range phase and entering a trend phase. If instead the market starts to form lower highs and lower lows within the trading range, the market is entering a bear channel, a bear trend, and it's leaving the trading range phase and entering a trend phase. For example, you look at this chart and you think, well, clearly a trading range. But what else do you notice about this? Okay, look at this high, and this high. We're getting lower highs. Look at this low and this low. We're getting lower lows. You can argue that we're getting higher highs over here, and we were, and higher lows. So you can argue that it's a bull trend. From this point onward, we're in a bear phase, possibly a bear channel. So, yes, it's a trading range, but it may also be the start of a bear channel, a bear trend. And this is what followed. We had a strong bear breakout from the trading range. We got another lower low, and then the trend accelerated into a strong parabolic channel into the end of the day. So we had a trading range, and it started forming lower highs and lower lows. It had a bear breakout, and it became a bear channel, a broad bear channel, and eventually it became a parabolic, very tight bear channel after this strong bear breakout. Okay, so what do you see here? Clearly a trading range, but we have a low, a higher low, maybe another higher low. We have a high, a higher high, another higher high. So it might be evolving into a bull channel. So it's clearly a trading range, but it's also possibly part of a bull channel. We got a bull breakout here, and we have follow through. We have a breakout bar, and the next bar has a bull body. So we have a trading range and the start of a bull channel, and now we're actually breaking out. And instead of a bull channel, this may end up as a bull breakout, a strong bull trend. And this is what followed. We did get a very strong breakout. So instead of this continuing up as a channel, it broke out into a strong bull trend, and it became a spike and not a channel. Weak channel or trading range. When you have weak channels that are mostly sideways and broad swings, they're usually also trading ranges. And it doesn't matter whether you call it a trading range or a weak channel. You treat them the same. You trade them the same. You look to buy low, you sell high, and you scalp. Here's an example. The entire screen is in a trading range, but you can also see that it's in a channel as well, forming a series of lower highs and lower lows. It doesn't matter whether you call it a weak bear channel or a trading range. You're going to trade it the same. You're going to buy low and sell high and scalp. So you're buying near the bottom and you're selling near the top and you're scalping. Here are some examples of other channels. Anytime you can draw two lines, you have a channel. Here the two lines are convergent. They're getting closer together, and it's a rising wedge. Here we have parallel lines. This is the most conventional type of channel that people consider. Here we have two lines, and they're getting closer together. They're convergent lines, and it's a triangle. All are types of channels. Here we have two lines containing the price action, and the lines are getting further apart. And this is an expanding triangle. In this case, we have a bear trend, an expanding triangle bottom, and a rally. I'll talk about this in a later module, but expanding triangles are always lower low. Expanding triangle bottoms are always lower low, major trend reversals, and strong buy signals. The market always has channels within channels and channels within opposite directions. We have a large bull channel, bull trend, and within it we have a pullback. And a pullback is a bear trend, and in this case the bear trend is in the form of a channel. Within that bear trend there's a rally, and that rally was contained within a channel. So within the bear trend there's a bull trend, and both are within a larger bull trend. So the market is usually within many channels all at the same time. How to draw channels? Let's look at the red line first. We can, as soon as you see 2 points, you can draw a line. So you can draw this line, and then if you want, you can create a parallel and drag it upward to a swing high that contains all the prices between the two original points. And that would be a trend channel line, and you look for an upside breakout and a reversal down to short. You can also, well, let's look at the blue lines. You can also use swing highs above the channel and connect them to create the top of the channel. So here's a high, here's a swing high. So you can connect the two with a line, and that also creates a channel. It doesn't really matter which you do. you use whatever looks like it's working. Whenever the price gets near either line, you see how it behaves. And if you see a reasonably good sell setup near the top, then you go ahead and you short. Again, the red lines are using highs and lows, so connecting highs up here, connecting lows over here, and then down here we have a new low, so you draw a new channel. The blue lines are parallels. You draw this trend channel line above, you create a parallel, and you drag it down here to a prior swing low, and that tells you to look in this area to see how the market behaves when it gets there. Red lines, again, are just drawn based on highs and lows. Blue line, it's a parallel from a red line. So here we drew a trend, a bear trend line across these two highs, created a parallel and dragged it down below. And you can see the market poked a little bit below it and reversed up. So you're looking for reversals on failed attempts to break out of the top or the bottom of the channel. Every breakout below a bull channel allows you to draw a new line. So we had this blue line here. The market broke below it and turned up. So you draw another line using this low. And what do you see about these two lines? The second line is flatter. The market broke below it, so you draw another line. It broke below it, you draw another line. Broke below it, you draw another line using the new low once the market turns up. And what do you notice about all of these blue lines? They're getting flatter and flatter, and the channel is getting broader and broader. That's the natural evolution of a channel. It tends to get breakouts, and each new line that you draw tends to be flatter, and eventually the channel gets broader, and it eventually evolves into a trading range. At some point, you can start drawing channels in the opposite direction, and the bears take control over the market. Sometimes you'll have several possibilities for the lower lines. So let's say you drew a trend channel line across these tops, or even this blue line here, and you're wondering where the bottom of the channel is. If the market's reversing down, you're expecting it to hit the bottom of the channel, but you have a whole bunch of possible bottoms of the channel. Okay, so your first bottom of the channel is here. It broke through it. It rallied a little bit, and it turned down again. You have another possible trend line here as a parallel of this line. It broke through that. So then you start looking for other possible bottoms to the channel. You take this line, create a parallel, drag it down to a swing low. That's a possible bottom to the channel. The market broke through it, did not turn up very well. It turned down again. So you take a parallel of this line and look for another swing low and drag the line down here, and maybe this will be the bottom of the channel, and maybe that will contain the price action. And ultimately, that's what happened. This is the market crashes in 87 and 2008 and 2009. Here's the inset for the 87 crash. Okay, look where the crash ended, exactly at a monthly trend line, right? So you have to think that there might be a channel there. However, anytime the market is making violent big moves, it's usually going to end at some kind of a trend line or trend channel line. Here's the 2008-2009 crash. And if you use the low of the 87 crash and then this low here and draw a trend line below, the 2008-2009 crash poked a little bit below it and reversed violently up. Now look at over here. There's one other obvious line from this swing low to the 87 crash low, and we did not reach that line. So that ultimately may end up being a magnet that pulls the market down to this level. At the moment, it does not seem likely, but you have to keep that in mind, that we have important lows, the 87 crash low, so it can create important trend lines, and the market may have to come down and test that lower line. Why are channels difficult to trade? Because uncertainty is high, and the reward sometimes can be low compared to the risk, and the channels are always trying to reverse. Sometimes the trend accelerates and has a breakout in the wrong direction. So you can have a bull channel and then a bull breakout, or a bear channel and a bear breakout, and it can accelerate into a stronger trend. I think this chart is interesting of Apple. You have a trend line along the bottom. You can create a parallel and you get this blue line, and we accelerated through the top of the channel into a stronger trend. However, when you draw another parallel and you anchor it to back here in 2007, the market touched that line exactly and then pulled back. Currently, the market is up here above the top of that channel. However, I think there's a pretty good chance that we're putting in the top for the next year or two, and that will work down to the bottom of the channel in Apple. The channel's rising, so by the time Apple gets there, it might be at 550, 600. But I think Apple's putting in a top up here, or at least the end of the bull run and the conversion into a trading range. This is a shrinking stairs pattern. I talk a little bit more about this in the module about trading. I'm just mentioning it here. We have a channel. I don't have the lines drawn in, but look what takes place. This pink box is this low, the breakout point. The market fell below it to the low of the next breakout point, and then we broke down to here. This box is the height of that breakout. This box is the height of the breakout below this low and the next swing low. And you can see how the breakouts are getting smaller and smaller. So the bears are losing momentum, and there are trades you can make based upon the shrinking of the stairs. You can fade the breakouts, and I talk about that in one of the later sections on trading bear channels. Here you can have a weak bull channel and a bear, right? You have a bear trend, and this channel looks very weak. It's not a strong bull trend. But look what followed. We ended up with a pretty decent bull trend. Look at what's going on here. We're falling below the lows of the prior bar, and then we're getting a big tail. We fell below the low of this bar and a big tail. We fell below the low of this bar and a big tail. And a big tail here. Fell below this bar, big tail. Fell below this bar, big tail. Remember, I talked about buying pressure, and it can be an early sign that the bulls are taking control over the market. And that's what all of these tails are telling us, that we're starting to accumulate a lot of buying pressure, and the bulls are buying below the low of the prior bar. So instead of looking at this as a bear flag and shorting on a stop below, traders are saying, oh, look at all these tails. We got several good bull bars. We had a bull bar here. We had a bull bar here. Maybe we're going to rally. So traders, instead of selling at the lows of the prior bars, are placing limit orders to buy at the lows of the prior bars, betting that we're in the process of channeling up. That is the end of the module on channels. This is Al Brooks, and this module in my price action trading course has to do with micro channels. A micro trend line, first of all, is any trend line on any time frame that you can draw across from 2 to about 10 bars, where most of the bars touch or are close to the trend line. Usually the bars are relatively small. And once you draw the micro trend line, you can create a parallel and put it on the opposite side of the bars to create a micro channel. The channel is very, very tight. In the old days, 20 years ago, people used to refer to it as a sign of a program trade taking place. You really just use the trend line. You don't have to draw the second line, because the trading takes place based on the trend line. You don't have to have 2 lines down there to trade. When you have a bull microchannel, it's a sign of buying pressure. As I said, years ago, people used to say that a buy program was going on whenever they would see a microchannel on the chart. A microchannel, the hallmark of a microchannel is no pullbacks. The bars keep going up, and the low of the current bar does not fall below the low of the prior bar. In a bear microchannel, it's a sign of selling pressure. Again, no pullbacks. The channel keeps going down, and the current bar does not go above the high of the prior bar. Once it does, the channel has ended. It can still be a tight channel, but I no longer use the term microchannel once pullbacks begin. Unlike a conventional channel where pullbacks are common, a microchannel progresses with no pullbacks. Sometimes you'll get one pullback and then the microchannel will continue for another 5 or 10 bars. You can call it back-to-back microchannels, or you can call it one very big microchannel, or you can call it an extremely tight channel. It doesn't matter what you call it as long as you understand that it's a sign of very strong trending price action. How do you trade them? It depends on where they're occurring. Both bull and bear microchannels can occur in both bull and bear trends, and both can have breakouts to the upside or the downside. A bull microchannel and a bear trend, it's an attempt to reverse. And since it's a bear trend and most reversal attempts fail, the bull microchannel should become a bear flag and the reversal attempt should fail. And it sets up a low one sell setup. So you place a limit order to sell below the low of the prior bar. As the channel continues up, at some point a bar will trade below the low of the prior bar, and that will trigger the short, and you'll be short. For example, here's a bear trend, and we have a bull microchannel. You can draw a tight trend line low across the lows of the bars. You don't have to draw the trend channel line on top. You can see that it's a channel and that it's very tight. And because there are no pullbacks for 4 bars, it's a microchannel. You keep placing sell stops one tick below the low of the prior bar, and you would have been filled on this bar. It's also a low one sell signal. It's a pullback in a bull trend, and it's the first pullback. You can also say, well, Al, it's a double top over here, so it's a low 2. That's correct. So you can call it a low 2 or a low 1. In a strong bear trend, you sell the first bear breakout of a bull microchannel. In a weak bear trend, you're usually better off waiting for a second entry, which would be in the form of a low 2 or a triangle. You wait to short the pullback from the breakout of the bear microchannel, of the bull microchannel in the bear trend. So, for example, this bear trend is not nearly as strong as the prior one, so I would call it a weaker bear trend. And here you have 3 pretty strong bull bars. I would not take the short below this microchannel. I instead would wait for the breakout, wait for the pullback, and then short below the pullback. Yes, the pullback went to a higher high, but that's common. On a smaller time frame chart, this would be a higher high major trend reversal. So when I have a weaker bear trend and then a bull microchannel, I do not short the low one, the first breakout. I wait and sell the second reversal down, which is a low 2 sell setup. Here's another tight channel, not so much a microchannel, and again I would wait for the second signal. Overall, this is a larger low 2 setup, so we have a low 1, low 2, low 1, low 2, but we also have a large leg up and a large leg up, so this is a larger low 1 and a larger low 2. Also, it's a double top, and all double tops are low 2s. It's also a low 4. Low 1, low 2, low 3, low 4. It doesn't matter what you call it. You simply have to recognize that it's a reasonable sell setup. A bear microchannel and a bear trend. The bull breakout is a reversal attempt. Reversal attempts should fail in strong trends. Here we have a bear trend. So you sell above the high of the prior bar. And you can also sell below the low of the pullback. So since it's a bear trend, you have to be looking for reasons to get short. So for example, we have a gap down, which is a spike, a pullback to the moving average, and now we have a bear microchannel and a bear trend. We have a pullback and went above the high of the prior bar, so you can place a sell stop to go short below that bar or even below the outside down bar. However, since it's a bear trend and you're looking to get short, you can also place a limit order to go short above the high of the prior bar once you start to see a bear microchannel. A bear microchannel and a bull trend. Okay, you have a bull trend and a bear microchannel. It's a reversal attempt, right? So you have the trend going up, and then you have a bear microchannel. So it's an attempt to reverse the market, and it should fail. So it should become a bull flag, and it's a reasonable high one buy setup. So you buy above the high of the prior bar. So here you have a very strong breakout, a bull trend, and there are no pullbacks. So it's a bull microchannel. Here the market went below the low of the prior bar, so we have a breakout below the microchannel. It sets up a high one buy setup, so you can buy above the high of the prior bar. In fact, this is a trend from the open bull, and it went up for 6 consecutive bars. Usually you can just place a limit order to buy at 1 tick below the prior bar. So you can place a limit order to buy below this bar. You would have been filled here. You can place a buy stop to buy 1 tick above the high of this bar because it's a 3-bar bear microchannel and a bull trend. So you can buy that. Here's a 4-bar bear microchannel, still in a bull trend. So you can buy 1 tick above the high of the prior bar. You can call it a high one. You can call this a high one. However, here's a double bottom. All double bottoms are high 2 buy setups, so this is also a high 2. You can buy above the high of the prior bar based on the bear microchannel. You can buy above the high of the bull bar because in general it's better to buy above bull bars. Or you can wait for this breakout and then we have a pullback and you can buy above the high of the pullback bar, especially since it has a bull body. 3 pushes down, 1, 2, 3. So this is also effectively a triangle in a bull trend, and you have a bull signal bar. So you can buy above the high of this for a triangle buy setup as well. So if you have a bull trend and a bull microchannel in the bull trend, any bear breakout is an attempt to reverse the bull trend, and a reversal attempt should fail in a strong trend. So you buy at the low of the prior bar, and you also buy above the high of the pullback, a 1-bar bull flag, a high 1 buy. For example, we have an opening reversal and then a very strong bull spike, and we have about 8 consecutive bars without a pullback. So it's a bull microchannel, and it's a clear, strong bull trend. We have these strong breakout bars. So you have to be looking to buy. You can place a limit order to buy at the bottom of the prior bar. You would have been filled here. And here we have a breakout below the bull microchannel. You can also call this a bull spike or a bull breakout. It's also a bull microchannel because there are no pullbacks. We have 8 bars without a pullback. So here we have the first pullback. We've dropped down for 2 bars. It's a high 1 buy setup. You can place a buy stop above the high of the prior bar, and you would have been filled up here. So it's a small bull flag. Suppose you have a weak bull trend, in other words, a bull channel, and within that weak bull trend you have a bear microchannel. In general, it's better to wait for a second entry, like a high 2 or a triangle. So, or you can wait for the breakout and then buy the pullback. Here we have a strong bull trend and we have a pullback. So it's a buy below and a buy above. Now we're immediately getting another pullback, so this might be a small final flag and we might be entering a trading range. So it's no longer as strong a bull trend. We have a bear microchannel. Should you buy it? You might be able to buy it on the basis of it being a double bottom for a scalp. You could also choose to wait and take the second entry. So we have the breakout, we have a pullback, and a second entry. You could buy above the high of this doji bar. In general, when the picture starts to become less clear, more trading range behavior, it's better to be buying above the high of a bull bar. So I would buy one tick above the high of this bull bar. So again, a bear micro channel that in a market that might be transitioning into a trading range, better to wait for a second signal here. Pretty good bull breakout, two very strong bull bars, and then another bear micro channel. You have an II, an inside bar, and a second inside bar. Both have bull bodies. It's near the bottom of the trading range. You could buy it on that basis. You could also argue a double bottom and in a bull trend and buy it on that basis. Or you could even buy above here. We have 4 bars up, a breakout from a large high 2, 2 legs down, large double bottom, and you could buy above this bar as a pullback from the breakout of the large high 2. A bull microchannel depends on context. For example, you have a very strong bear spike here, and now you have a pretty strong bull microchannel. The bars are small, the bodies are small. You probably can short the breakout. If you're not sure, wait to short the pullback, the second entry. So we have a bear breakout of a bull microchannel and probably a bear trend. Unclear. Don't take the first one, wait for the second one. It's also a double top, so it's a low 2 short. Again, context. We have a bear trend, a trend line break, and then a lower low in the form of a wedge bottom, 3 pushes down, 1, 2, 3, and a possible reversal up and a lower low major trend reversal. So we have a bear trend, a trend line break that is pretty strong, and then we gradually drifted down to a lower low where we have a pretty decent reversal bar and 3 pushes down, a wedge bottom. So this could be a pretty good major trend reversal. Now we have 6 consecutive bull bodies on the reversal up in a microchannel. No pullbacks, so it's a microchannel. You can argue it's a bear flag in a trading range. At this point, it is a trading range, but it's also the start of a bull trend. So here we have a bull microchannel, potentially a bear flag in a trading range, but the market probably has flipped to always in long, so I would not take that short. I think it's a reasonable buy actually below the low of this bar and above the high of this bar. In here, maybe by here, traders believed that the market was always in long, so at this point you're looking for reasons to buy, and you'd expect there to be buyers below the low of the prior bar, so I would not short that. I would be buying at its low and above the high of this high 1. Again, a bull microchannel in a trading range, but also in a new bull trend, a low major trend reversal and a pretty strong move up. At this point, the market is bullish. Here we have a very strong bull bar closing on its high, the biggest bull bar in the entire rally. We're approaching the top of the trading range. You could buy this close, or you could wait and buy this close, and you could buy this close as well. In the module on breakouts, I talk about how to manage these trades, how to place stops, and how to go for profit targets. That is the end of the module on microchannels. This is Al Brooks, and this is my price action trading course module on trading ranges and vacuums. A trading range is an endless pullback. When a pullback grows so long that it loses direction, and when you look at it and you can't tell whether the breakout will be to the upside or the downside, then the pullback has become a trading range. The prior trend is so far into the past, so far to the left of the screen, that it has lost influence over what's going on. For example, if you have a pullback in a bear trend you'll expect a bear breakout and a resumption of a trend. Pullback is part of a trend. But if the pullback grows for 20 or more bars, the bear will be so far in the past that it will have lost influence over what's currently taking place. Traders will stop using the term pullback and they'll begin to use the term trading range. And the longer the trading range continues, the more likely that the market is totally uncertain. It will break out, has an equal chance of breaking out above as it does below. Here's a bear trend, pretty big bear breakout, possible trending trading range day, upper trading range, possible start of a lower trading range, and at this point we have a pullback. The pullback is growing. Now it's about 20 bars, probably still going to have a bear breakout, but it's getting less clear. We're getting too many bars. Why have the bears been unable to make the market break to the downside? What's going on here? Something's not right. After 20 bars, the bear has not resumed. At this point, 30, 40 bars, the market has lost its direction, and now it's equally likely that we'll get an upside breakout as it is that we'll get a downside breakout. So when you're at the point that you really can't tell which direction is the most likely direction for the breakout, you stop using the term pullback and instead you refer to this as a trading range. This particular trading range ended up breaking out to the upside. There was actually a higher low major trend reversal here. I'll talk about that in a later module. You have a bear trend, a trend line break, sideways for about 10 bars, higher low, and upside breakout. So some traders would start buying in here, hoping that this would result in a major trend reversal. In trading ranges, you're expecting breakouts to fail. Trading ranges are always trying to break out. You'll see sharp moves up to the top. They look like they'll have a lot of follow through and the breakout will be successful. 80% of them will fail. The market will start turning down. It'll race to the bottom, accelerate near the bottom, look like it's going to break out. Beginning traders start to look for shorts. Experienced traders instead start to look to buy because they know that the sell-off, no matter how sharp, is probably going to fail and lead to a reversal back up to the top of the trading range. So you expect reversals back into the trading range, and you should look to fade breakouts. Fade means go against. So if the market's trying to break to the upside, you fade it. You look to short. If it races to the bottom, you look to fade the bear breakout attempt, and you look for reasons to buy. Here's an example of a trading range. Very strong bull spike. Beginners are looking to buy. Experienced traders are looking to sell. Very strong bear trend down for about 15 bars and two very big bars here at the bottom. Beginners are shorting. More experienced traders are looking to buy. So they'll buy above the high of that bar. Again, a very strong bull spike. Looks like we're going to break out. This is going to be a great bull trend. Experts are waiting for the breakout to be confirmed. They're waiting for a breakout and another bar above. Don't get it. Instead, we get a bear reversal bar. Same thing over here. So in trading ranges, the market races to the top, it races to the bottom, only to reverse. So you should be trading it that way. You should expect the breakouts to fail. 80% of them do. Ultimately, you get a successful breakout. But most of the attempts will fail. There's a reason why trading ranges are always trying to break out, and that's because eventually they do. And within the trading range, usually there are bull arguments and bear arguments. The bulls are taking positions looking for a bull breakout. The bears are taking positions looking for a bear breakout. And when the breakout finally occurs, if you look back a little bit into the trading range, you'll see that the trend actually began within the trading range. So within trading ranges, there usually are the beginnings of both bull and bear trends. Eventually one side wins and the other succeeds, but there'll be many attempts by both before the result is known. And when you look back after the breakout, you'll see the start of the trend, and you'll see that it actually was within the trading range. So within the trading range, there is the start of a bull trend and the start of a bear trend. Most of the starts will fail and lead to reversals, but eventually one succeeds. Here's an example. We have a bear trend and then a trading range. And at this point, the bulls see a bear channel, a trend line break, test of the moving average, and a higher low. So at this point, the bulls see a higher low major trend reversal, and hopefully, on their part, the start of a bull trend. If the market ended up here instead of down here, traders would look back and say, yeah, this was the bottom, this is the start of the bull, and here's where the trend reversal began at the higher low major trend reversal. So during these bars, the market is in a bull trend. On the other hand, the bears look at the same chart and say, we have a bear trend, and we have a lower high, and now we have a double top bear flag, so we're still in the bear trend. And if the trend ends up down here, which it did, they'll look back and say, oh, this is just a two-legged pullback within a bear trend, and the bulls really did not have much of a chance. So within this trading range, it has the start of a bull trend and the start of a bear trend, or a continuation of the prior bear trend. But during the trading range, if a trading range goes on this many bars, it loses its predictive value, and the breakout can, in fact, be in either direction. Here's an example, a similar situation. There's a bear trend. There's a tight bear channel and a trend line break, and a lower low major trend reversal, and the bulls tried to reverse up, and we're still in the trading range here. Now it's a broader trading range, it's above this high, and the bears tried to generate a reversal and resumption of the trend. In this case, again, a two-legged pullback in the bear trend. This time the pullback is above the earlier one, but it's still an acceptable formation for the bears, and they had very good selling pressure. Bear bar, bigger bear bar, another bear bar closing on its low, followed by two more bear bars. So for the bears, they see this as a trading range within a bear trend, and they see the continuation of the bear trend at this point. And if the market did in fact trade down, they would say, sure, this is just a rally in the pullback, and in fact the bear trend was, the bears were in control the whole time, and this is clearly the start of the next leg down. However, until that next leg down breaks free of the trading range, it's still within the trading range. So within this trading range, we have a lower low major trend reversal, and we also have a higher low major trend reversal. So the bulls see this as a bull trend. It turns out they eventually were right, and people will look back and say this is the bottom of the bull. However, the reality is, until we started getting this strong bull spike above the top of the trading range, we were still in the trading range, and the bears could have pushed it down. And if they did, they would have said, this is the start of the next leg down in the bear. So within this trading range, there is the start of a bull trend and the start of a resumption of the bear trend, which is usually the case. In trading ranges, usually the bulls and the bears both have arguments, and both are being traded by institutions. There are institutional bears selling here, institutional bulls buying throughout the trading range, and that's why the market's in a trading range. Both the bulls and the bears see it as a good area to initiate positions, and they're both ultimately profitable if they trade this 10 times and manage it correctly. How could the bears possibly be profitable? Well, if they shorted here, they may have taken partial profits here and gotten out break even here. And how could the bulls be profitable? They could have bought anywhere up here, and they could have scaled in here, took partial profits here, and then rode the rest up. And so within a trading range, there are bullish and bearish ways to be profitable if you manage your trades correctly. As individual traders, the best way to trade it is to buy low, sell high, and scalp until there's a breakout. There's often evidence of the direction of the breakout while the trading range is forming. you start looking for series of bull bars. For example, here you get 4 consecutive bull bars. Here we get 4 more bull bars and 3 more bull bars, and the third one has a pretty big body. Here the bears have 4 bear bars, but the bodies are getting smaller and smaller and smaller. So the selling pressure is not as strong as the buying pressure, and that increases the chances for the bull breakout. I discussed this more in the module on pressure. Here we have a market that gapped down and probably became always in long after this strong bull reversal bar, and certainly with this bull breakout with close on high, close near the high, and now even a bigger bull bar. So the market's probably always in long here. It tried to become always in short with the bear breakout, but no follow through, instead a bull reversal. And it entered a trading range. It got raced up to the top and then sold off. Raced up to the top, sold off. You can draw it as a triangle. A triangle is a type of trading range. In this particular case, the bears will argue, well, this is just a lower high. We have a high and a lower high, and now we have another lower high and another lower high, maybe a double top bear flag. So the bears are positioning themselves for the bear breakout. When it gets near the top, they're shorting. The bulls, on the other hand, see a low and a higher low and another higher low and another higher low. So the bulls are looking at the higher lows, the bears are looking at the lower highs, a triangle, and both are positioning themselves for a breakout in their direction. Again, you can look at buying and selling pressure, you can look at always in to make a guess as to which direction is more likely. However, the further the market goes to the right, the more bars we get to the right, the further we are removed from this bull spike, and the less influence the bull spike has on the market, and it increases the chances that the breakout could go in either direction. Okay, strong trends can suddenly reverse. Is it because of something in the news? Television always says that the market turned down today or the market turned up today because of some news event. There are news events taking place every minute, all day long. If the market suddenly breaks out, reporters will look at the current news event and say, that was the reason why the market broke out. And that's not it at all. You know, if you're a TV reporter, you assume that everything that happens in the world is related to the news, because that's what you believe. You believe everything is related to the news. The reality is, most of what takes place in the market is technical, and it has nothing to do with the news. When a very strong trend suddenly reverses, again, it's technical. But you need to know the targets. You need to know the reasons. The market is quickly drawn to support and resistance. They act as magnets. And like any magnet, the closer the market gets to the magnet, the faster it moves. So you start to get bigger and bigger trend bars as the market races toward the magnet. That is the vacuum effect. The vacuum effect of magnets. Support and resistance are magnets, and they quickly draw the market to them. I talk about this in the modules on measured moves, support, and resistance. What are typical support and resistance areas? Magnets. Trend lines are obvious ones. Prior highs and lows. And measured move targets. For example, if you have a trading range, the height of the trading range often leads to a measured move projection where the market will race. Let's say you have an upside breakout from a trading range, the market will race up to a measured move based on the height of the trading range. Let's say you have a strong bear spike, the market will often fall a further number of points equal to the height of the spike. Let's say you have a market moving up and then it suddenly breaks out. That breakout could end up being a measuring gap, and the market may move up to the same number of points above that gap as it took to get to the gap in the first place. Example of a vacuum effect. Vacuum effect here. Racing to the bottom, reversing up, racing to the bottom, reversing up, racing to the top above a prior high, and reversing down. What was it racing to? Well, here it reversed exactly at a trend line. Here, it reversed exactly at a trend channel line. And in fact, this became an expanding triangle. So you have to know what to look for. So I'm always drawing lines and measured move targets because those are magnets and the market often races to them, and then I look to see what the market does at that area. Look at here, the height of this trading range. These pink lines, the bottom of the range, top of the range. Here's the measured move up. The market turned at that area as well. Here's a gap. The high of this bar is above the close of this bar is above the high of this bar. Also, the low of this bar is above the high of this bar. So we have a gap in here. And it could be a measuring gap. So you can look for a measured move based upon the middle of this gap, from the bottom of the move to the middle of this gap. Once the market gets close to the top or the bottom of a trading range, it's within the gravitational field of the edge of the range, and the closer it gets, the stronger the magnetic pull, and the market moves faster and faster and faster as it gets to the top. And it starts going down. When it gets near the bottom, it gets faster and faster, big bear trend bars. And once it gets there, the magnetic pull is turned off and the market's free to reverse. The moves up and down always look strong enough to break out. And traders, beginning traders, will see the market race up and they'll start buying with limit orders as the market's pulling back. Or if it pulls back for a bar or two and starts to turn up in a high one, they'll buy that. They'll only see the bull spike racing to the top. They'll forget all the bars to the left, the trading range. And they'll lose because 80% of these strong breakout attempts fail and the market reverses and then races down to the bottom of the trading range. Again, once the market hits the magnet's turned off and the magnetism disappears, the market usually reverses. Again, the move up or down looks so strong that beginning traders are always looking for a pullback. They want to catch the second leg. They want to be early in the breakout. So if they see the market race to the top and there's a small pullback, they want to buy that pullback because they think that the move up was so strong it has to have a second leg. So they're looking to buy. And they want to make sure that they enter the successful breakout early on. And they get trapped. The market goes up for a bar, forms a small double top, and reverses down. So beginners are always buying at the top and they're selling at the bottom. And that's the exact opposite of what the institutions are doing. And if you're going to make money doing this, you have to be doing what the institutions are doing, not the opposite. Beginners are always trapped into buying high and selling low. So when that market races to the top and it starts to pull back and the beginners are buying, the pullback just keeps growing and growing and growing. And the beginners are wondering, what's going on? I should get a second leg. I'm losing money. And eventually the pullback starts to accelerate as all those early bulls start to dump. The market starts to race down. And the traders with losses are exiting. The market gets vacuumed quickly down to the opposite end of the trading range, the bottom of the trading range, and then the process repeats going up. Strong bull spikes near the top. The bears think the market will go a little higher. So let's say we're right below the top of a trading range and we're starting to race up, but we're not quite there yet. If you're a bear, you see the top of the trading range. You think the market's going to go a little bit higher. So why are you going to short here when you are pretty confident it's going to get here in another bar or two? So the bears stop selling. But once it gets to their target, they start to short heavily. The bulls expect the same thing. And they wait to take profit. So as the market's racing up and it's not quite up to the top of the range, the market's racing up, the bulls aren't going to take profits until it gets up there. Once it gets up there, the bulls sell. They sell to take profits. Once it gets up there, the bears sell. But right before the top of the range, nobody's selling. The bears aren't selling because it's going to go a little higher. The bulls are not selling out of their longs because they know it's going to go a little higher. So when there are no sellers just below the top of the range, the market races up quickly to get to the top. It gets sucked up to the top. It gets vacuumed up to the top of the range. And that's how you get those big bull bars at the top of the range and those big bear bars at the bottom of the range. A strong bear spike near the bottom of the range, bulls want to buy, right? So as the market's getting down here, the bulls don't want to buy here, they want to buy down here. So the bulls stop buying, so there's no buying by the bulls. The bears are looking for places to take profits. They know it's going to get here, so why would they buy back their shorts here? So the bears stop buying. So once the market gets near the bottom, the bulls are not buying, the bears are not buying, no buyers left, the market crashes very quickly for a bar or two and a big bear trend bar. But once it gets to the target area, the magnet, the support, the bulls buy aggressively, expecting a reversal up. The bears buy aggressively to take profits on their shorts, and then the market reverses. So it gets vacuumed down quickly to support, and then finds buyers. Again, the breakout attempts look strong, but they fail. The market races to the top, races to the bottom, races to the top. So for example here, the bulls who bought in here are looking to take profits. They want to take profits around the prior high, which might be the top of a trading range. So when the market gets right here, those bulls are not willing to sell. They want to wait until it gets up to the top. So the bulls are not selling. The bears also know it's going to get to the top, so they're not going to sell here either. They're going to wait until it gets up here. So with nobody selling, the bulls are not selling, the bears are not selling, the market's going to quickly race up there. But once it gets here, what happens? The bulls say, oh, it reached my target, I'm going to sell out of my longs to take my profits. So the bulls start to sell. If the bulls are not buying, they're selling. Once it gets up here, the bears, they start to sell. Top of a trading range, it should go down. So now you got the bulls selling and the bears selling, nobody left to buy. Starts to pull back. Beginners say, oh, I'm going to buy here for another leg up. This leg up was so strong, we're probably going to get a breakout. No, you're probably going to get a reversal because it's a trading range and most breakout attempts fail. Starts to drift to the bottom. The premature bulls have to start exiting. Once we get near the bottom, the market gets vacuumed down. No buyers until we get near the bottom, and then the process reverses. Ultimately, you get a successful breakout. But most of the time, you do not. You get a reversal. Okay, an example near the top of the trading range. Both the bulls and the bears see it as resistance. Once the institutions believe it'll test just a little bit higher, the bears stop selling and wait to short higher. The bulls expect the test and they wait to take profits, sell out of their longs until the market gets a little bit higher. Since both believe the market will get higher, it does not make sense for either of them to sell until the market gets higher. This creates a buy imbalance. Nobody wants to sell yet, so the market races up to a price level where sellers suddenly appear, and it can race up in the form of 1 or 2 or 3 very large bull trend bars. It gets vacuumed up to the resistance level, and then the strong sellers appear out of nowhere. The bulls sell strongly to get out of all their longs. The bears sell strongly to initiate shorts. Nobody's left to buy at this price at the top of the range. The market reverses even though the rally up was extremely strong. The market gets vacuumed down to the bottom of the range, and then the process repeats in the opposite direction, and then the market reverses up. So don't bet on breakouts. The market failed here, it failed here, failed here, failed here. Ultimately, it succeeded. Look at this. You have a breakout attempt, a pullback, it failed. Market went up. Over here, premature bulls thought, wow, what a great bull flag. We certainly will get the breakout. Bad trade. You don't want to be buying near the top of a trading range. In a trading range, you want to buy low, sell high, and scalp. So we're high. I don't care that it's strong. We're high. You buy low in a trading range. You don't buy high. Here, you don't sell low. We've been in a trading range for about 10 bars. You don't want to sell low. You only want to buy low. So in fact, a lot of times in a situation like this with a weak sell signal, I'll place a limit order to buy at the low of this bar, and I would get long here. Similarly, up here, top of a trading range, I'm looking to sell. Buy low, sell high, or high, I want to sell. So I think this is a bad buy, probably a good sell. I'll place a limit order at the high of the prior bar, and I'll get short right here. So in a trading range, you want to buy low, near the bottom, look for reversals, and then near the top, you want to sell. In bear reversal bar, you short. It's better to bet that the breakouts will fail, and you'll be right 80% of the time. Eventually, you'll get a successful breakout. But rather than buying the breakout attempts, it's better to wait to see if the breakout is strong. Wait to see if there's a big bull breakout bar, trend bar, breaking out above the trading range. The context has to be good. It has to make sense that a breakout should be occurring now. You also might want to wait for the bar after the breakout. Let's say we have a bull breakout. Maybe you want to wait until the next bar to make sure it has a bull body, or the bar after that to make sure it has a bull body. And you can say, well, Al, that's waiting a long time. I'm missing a lot of the move. Yes, but you're paying for that reduced profit. What you're getting in return for that reduced profit is increased probability of success. The move is much more certain. A breakout, it can be a very strong breakout, or it can be a slow transition into a channel. Very often, the market is in a trading range and in a channel at the same time. And the channel traders, the traders who believe the market's transitioning into a trend, will start to position themselves early. Here's a trading range all day long, and then there was an FOMC report at 9:30, and it led to a huge breakout. This bar is actually huge. It's almost a 1% move in 5 minutes. This one bar was enough to flip the market to always in long. Buyers would place stops, protective stops below the low of the bar, and they would buy for a swing, expecting that there would be substantial follow-through from the breakout up. Here we have a trading range, and it broke out to the downside, but it became a bear channel instead of a strong bear breakout. Big swings both ways. At this point, traders are wondering, is it still in a trading range? The whole screen is still in a trading range at that point. The trend traders are betting that it is, and they're shorting strong bull closes, betting that we'll start to get a series of lower highs and lower lows. So it's very common that the market is both in a trading range and in a channel. So this right here, it's a trading range, but low, lower low, lower high, lower high, lower high. Yes, it's a trading range, but it's also beginning to form a bear channel. You can see the module on pressure, breakouts, channels, and the modules on trading breakouts and channels to get information on how to trade when the market looks like this. Buying or selling pressure. All trading ranges eventually break out into trends. There's usually an imbalance between the buying and selling pressure that gives a clue to the direction of the breakout. And it oftentimes allows traders to enter swing trades before the breakout. Remember, in a trading range, buy low, sell high, scalp. Sometimes if you're starting to detect an imbalance between the buying and selling pressure, you might want to take a swing trade in the direction of strength. If the bears look like they're getting stronger, if we're starting to get a lot more selling pressure than buying pressure, even though we're still in the range, you might want to take a short and look to swing it, betting on a successful transition into a bear trend. Okay, the entire screen is a trading range. We went down, we went up, and down, and up, and down, and now we're trying to go up. We went down pretty strong here. We're going up pretty strong here. But take a look at what's going on here. We have 7 consecutive bear bars, very good for the bears, but they were followed by 3 consecutive bull bars and here 4 consecutive bull bars. So we're starting to transition into buying pressure. And look at this more recent sell-off. This one had 7 consecutive bear bars, but here, how many consecutive strong bear bars do you see? Here's a good bear bar, but the next bar is not a strong bear bar. Here's another bear bar. Next one has a bull body. Here's another bear bar. Next one is a doji. So what's going on here? Why are we no longer getting bear bar, bear bar, bear bar, bear bar, right? We're transitioning. The bear leg is becoming weaker. The bull leg is becoming stronger. So we're starting to transition from selling pressure into buying pressure. So traders are starting to wonder if the bulls are taking over. Look what's happening over here. Look at the low of this bar. We get this bar breaking out. Its close is above this bar. And look at the low of the bar after it. It's above the high of the bar before. This bar, another breakout, close above the high of the bar before. But look at the bar after. The low is above the high of the prior bar. So this is a gap. This is a gap. So not only are we getting a series of bull bars closing near their highs, we're starting to get gaps on the way up. Again, a sign of strength, urgency, buying pressure. So this market looks like it's transitioning into a possible bull trend. So traders might start to buy in here, betting that we're going to get an upside breakout and a swing up. You could always wait for the successful breakout and then buy, but if you see the market transitioning from strong selling pressure into buying pressure, you might want to think about starting to get long early. And this is what took place afterwards. This is what followed, a huge bull trend. The market probably was always in long at this point. By the close of this bar, most traders were thinking, yeah, it's probably going to go higher. And then this bar and this bar, traders are thinking, yeah, look at this, 3 big bull bars. Following 3 other bull bars, the market's accelerating to the upside. We're breaking out above the top of the trading range. You can see the module on trading strong bull breakouts on how to trade this. But once you know it's always in long, you have to think about buying, even buying at the market, buying the close, buying the low of the prior bar, buying a high one. You have to get long. Buying a triangle, 3 pushes down, 1, 2, 3. You have to get long. Even when the chart is in a strong trend, it'll have periods of two-sided tradings. When the periods are brief, it's a pullback and you're expecting the trend to resume. And when it's long, 10, 20, 30 bars, you call it a trading range. To me, any area of two-sided trading is a trading range, even if it's just a single bar. So if you're in a strong bear and you have a 1-bar pullback, that 1 bar is a trading range. It certainly is on a small enough time frame chart. For example, if you're looking at a 60-minute bear trend and you have a 1-bar pullback, that 1-bar pullback has 60 1-minute bars in it. So on the 1-minute chart, it's certainly a trading range. Small trading ranges are pullbacks. Big pullbacks are trading ranges. When you think the market's going to resume, it's a pullback. When you can no longer tell whether the market will resume or reverse, then I use the term trading range. All pullbacks are small trading ranges on the chart that you're viewing, and all trading ranges are pullbacks on higher time frame charts. As long as you think the trend will resume soon, the trading range is a pullback, and you should only trade in the direction of the trend. But once the trading range has lasted so long that it's lost its short-term predictive power, at that point, it's so far from the trend that the trend has lost influence, then I use the term trading range. Uncertainty is the hallmark of a trading range. Whenever you are uncertain whether the market will resume or whether the market will break to the upside or the downside, then the market's in a trading range. Uncertainty is the hallmark of a trading range. Whenever you look at the market and you're confused, the market's in a trading range. Buy low, sell high, scalp. You want to sell near the top, you want to buy near the bottom. Bulls always want the market to go a little bit lower. So when the market's trying to sell off near the bottom of the range, the bulls want it to get lower, but just in case it doesn't, they start to nibble. And a lot of times it doesn't get as low as they want, and the market reverses up, right? Bears always want to sell a little higher, so when it gets near the top of the range, they start to nibble into shorts. They start to build into short positions. And a lot of times it never gets quite as high as they want, and then the market reverses down. There are always sellers near the top, pushing the market back toward the middle. There are always buyers near the bottom, pushing it back up toward the middle. And the market ends up spending most of the time in the middle, and very little time near the bottom, and very little time near the top. Prices keep getting pushed back to the middle of the range and spend very little top near the extremes. Why does it not spend time near the extreme? Because near the top, everybody wants to sell. And if everybody wants to sell, the market's going to have a hard time getting up there. At the bottom, everyone wants to buy. If everyone wants to buy, there's not going to be very many people willing to sell down there. It's going to be very difficult for the market to get down there. So you buy low, sell high, and scalp. Right? That's how you trade trading ranges. You scalp, you don't swing, because 80% of the breakout attempts will fail, and most moves will soon reverse back down to your entry price. So if you buy at the bottom looking for a swing, it goes up, it'll come right back down to your entry price. So it makes more sense to buy near the bottom and take profits in the top half of the range, and then look to sell near the top and then take profits on the bottom, in the bottom half of the range. So if you buy near the bottom, the market will trade to the middle and probably all the way to the top. Instead of breaking out, there'll be a sell setup, and then the market will return back to your long entry price. So you don't want to buy down here, watch it go up here, and then watch it come all the way back down to your entry price. You have to take profits. You can't be trading break even repeatedly in a trading range. You got to be doing this to make money. If you sell near the top, the market will trade down far enough to scalp out a profit, and if you don't take your profit, the market's going to come back to your entry price. So you'll end up getting yourself stopped out around break even, and you'll have missed the opportunity to take a profit. So you should be scalping. How can you tell that the day is going to be a trading range day? Very often the very first bar of the day, or the first 2 or 3 bars, or the first 10 bars will give a sign that trading range behavior is strong and that the day will probably be a trading range day. Trend days often give signs early on that the day will be a trend day. So you got to pay attention to the first bar, the first 2 bars, the first 5 bars, the first 10 bars, and a lot of times you'll see evidence of the kind of day that the day will become. For example, if the first bar of the day is a doji, or if there are several dojis in the first hour, lots of overlapping bars, if it's opening up within a trading range of yesterday, if you have repeated reversals in the first hour, if you have bull bars and then bear bars and bull bars and bear bars, right? All of that is signs that both the bulls and the bears are equally active, and it probably means that the day will be mostly a trading range day. Also, if the moving average is flat, and again, if there is no gap, if today opens right around yesterday's close, if yesterday was a trading range day, and then you can use your personal radar. If you look at the first few bars of the day and you say, wow, I don't know if I should be buying or selling, right? Or if you feel like, oh my God, I got to make money and the market's not giving me a good setup. Those are signs that the day is probably a trading range day. And just relax. Once you know it's a trading range day, you know how to trade it. You buy low, you sell high, you scalp. So here we go. Bear breakout attempt, but a tail. Another bar with a tail. Another bar with a big tail. A breakout attempt, but a doji bar. A big bar here, but a big tail, small body. Sideways, 5, 6, 7 bars, all sideways, small bodies. Many reversals, bear bars, bull bodies, bear bar, bull bodies, bear bar, bull, right? Trading range price action. So you have to wonder if the day will be a trading range. You see prominent tails, you see reversals, the bars are all sideways, overlapping, and there are no strong gaps. no bars closing below prior. Well, here's a small gap, but it immediately closed on the next bar. This close is below that low. Up here, no gaps. The market went above that bar, but it closed back below its high. So when you look at this, you're probably anxious and confused. That tells you that the day will probably be a trading range day, and so you should look to sell high and buy low. That's the end of the module on trading ranges and vacuums.